I think what I'm trying to work out, Callum, is yes, on the depth side of things, I understand there's a really strong consensus over the shallow. But on the short-lived piece of this, Callum, isn't there a real risk here that we have below-trend growth for quite a period of time once this starts to kick in?
Below-trend growth or a slow recovery from a shallow recession is possible. What I don't think we need to worry too much about is this kind of L-shaped shock that we are often warned about. What I notice is economist models lack one thing, and mine included, of course, imagination. We always have a backward-looking approach to forecasting the future, which means when we're missing a key element from our historical model, in this case, let's say you have 5% less energy in the world because you have the supply-related issues due to the Russian invasion of Ukraine. You say, well, how can our economy ever be 5% bigger? Or, excuse me, how can we not reverse this 5% drop? Well, what we don't factor in our models is the fact that we become more energy efficient, that we, through the price mechanism, react to the price signals and profit signals, and in the end, we adapt. We have 100 years of economic history of reacting to shocks. The price mechanism works things out, and then the economy rebounds. Just look at how quickly we recovered from COVID. And so my bet would be that it's animal spirits, it's our bearishness that makes us think about the world in this context. But actually, once we start to see the movement towards a recovery, probably by summer next year in Europe, late next year in the US, we start to feel optimistic, and we can easily imagine a world in which we get something stronger during the recovery phase.
Hey, Callum, this was thoughtful stuff. I appreciate it, sir. As always, Callum Pickering there of Berenberg. Looking ahead to 23 and that consensus that if we get a downturn here, Bramo, it will be short and shallow.
Yeah, and a lot of people pushing back. And I have to be honest, I was speaking with Howard Marks yesterday of Oaktree.
How did that go?
He was talking about, it was fascinating. He's saying that he's lived through 3 sea changes in the investment world during his career. And right now we're in the 3rd. And we're heading into a new era of probably higher interest rates. And where suddenly you're not going to have that tailwind of falling interest rates. And what are the consequences of that? And it does speak to potentially, and this is my extrapolation, a lot more pain out there, a very different risk-reward calculus. And, you know, how to even understand what's going to happen is to understand where we are, and people cannot agree even on that. I mean, for example, is the China reopening inflationary or deflationary?
You tell me.
I mean, Bridgewater came out and said it's inflationary, and that actually is the worst-case scenario for the U.S. and Europe because it will actually increase demand for some of the commodities out there, jack up inflation just as Europe slows down. I mean, again, you get 5 people in a room, 5 different opinions.
Isn't that always the way?
I feel like it's more like that recently. I feel like the bifurcation between the different views is dramatic, and I do feel like there still is a faith we're heading back to a low-rate, low-inflation regime.
Oh, the pre-pandemic playbook.
It's just how we get there.
Without a doubt.
I don't see any evidence on the economic side that we're really heading back to that so quickly.
When you have 10 years of conditioning, it takes a while to shake it off. That was the pushback from Savita Subramaniam over at Bank of America. People just want to gravitate back towards tech and the stuff that used to work and rewarded them so well for 10 years. And Lisa, she's asking whether it will going into 23.
And at what point do people capitulate to that view? We were hearing that from Steve, right? If there is some sort of slowdown in growth, do people think, okay, this is it, go in and then get slammed with a downturn?
The discipline of 5% interest rates. No baseball caps and hoodies.
I was about to say suits and ties, heading back to the office.
Suits and ties back in the bank. You know.
Unless you're at Citigroup and you get to take the rest of the year off.
I saw that. You can work anywhere at Citi for the next 2 weeks.
I know.
You can work any way you like.
Do you guys want someone who can interview people?
Jane Fraser, love that.
I know. I think
love
that's
that.
fabulous.
2 weeks. That's very English,
Christmas.
you know. Christmas starts, like December kicks off. It's like, okay,
but
year over.
Don't you feel like that's the mood right now in markets generally? Come on.
Totally. You need to take a leaf out of Europe's book. Just like December 1st, it's like year over. Just like,
me, or
shut it down.
Somebody else.
I'm just saying, just shut it down. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. 2 top Democrats say President Biden should run for re-election in 2024. In an interview with CNN, House Speaker Nancy Pelosi said Biden has been a great president, while Senate Majority Leader Chuck Schumer said he would support Biden all the way. The backing comes as some Democrats urge the party to look for a younger generation of leaders. At 80-year-old, Biden is the oldest president to hold office. Members of the European Union have reached a deal on a 9th package of sanctions on Russia. They target Moscow's access to drones, more banks, and officials said to be responsible for kidnapping children from Ukraine. There are also export restrictions and chemicals on technologies used for military purposes. In the UK, consumer confidence is lingering near a record low for an 8th month. That's according to a survey by GfK. The results show the impact that rising prices and the possibility of a recession are having on UK households. And workers at 50 Starbucks locations in the U.S. are starting a 3-day strike today. They say the company isn't bargaining fairly with stores that have recently unionized. The labor group, called Starbucks Workers United, has prevailed in elections at about 270 Starbucks stores this year. The company says it hasn't engaged in anti-union activity. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Happens when China, the largest commodity consumer in the world, the largest oil importer in the world, begins to rebound significantly in the first part of next year. It's going to tighten all of these markets tremendously and put a lot of upward pressure on prices.
Jeff Curry at Goldman Sachs looking for triple-digit crude again in the back end of next year. And Bramo, it's all about capex or the lack thereof. Earlier this year, if you were looking for a rebalance to this commodity market, Jeff Curry and the team at Goldman saying, you're not getting one.
And the super cycle is still there and still intact. And we're hearing this from a lot of the big Wall Street banks that were honestly wrong where we would end the year in terms of it being double digits. And somehow we see dropping oil prices, even as China reopens wholesale earlier.
Down a little bit today, down 2% at 79.58. But Jeff's not alone. I think Francisco Blanchard, BofA, looking for triple-digit crude through next year as well. Does this go to what Jensen's talking about over at Bridgewater? Inflation, China back online, demand pops back in, clicks back in, and crude is going up?
It makes complete sense to me. I'm going to be completely honest. It absolutely makes sense. Rita Sen over at Energy Aspects saying the exact same thing. And right now you have basically a ghost town in Beijing as a result of everybody being sick and everybody staying home.
Nuts, isn't it?
But when that changes, and it will change.
Of course it will.
Then all of a sudden you could have a very different economic backdrop with a very different and increased demand.
We're not going to get that clean reopening. We didn't get one in the West. It's going to be bumpy. It's going to be lumpy. But ultimately, to your point, you get through these waves and demand starts to pop back in.
I would argue that it will be actually less bumpy if they're just letting it go. Because if they don't even try to lock it down and they're just basically not reporting any of the deaths, which is what's happening right now, and not reporting any of the infection numbers, but the morgues are reporting that they're cremating many more people than they had previously, and all of a sudden you just let it rip, then there will be a collective immunity that might come sooner.
Sure, but in the near term, you know how this works. People self-regulate. even if the government doesn't. People are self-regulating. You see it in the mobility numbers, and I think we're already seeing that. You see that on trading floors. I can't believe the volume's down off the back of this reopening in China. I've seen some of the statistics around that story in FX. I want to bring you a flavour of the price action right now. Equities are down, lower, negative, softer by 1% on the S&P. Futures are down across the board here. Yields up just a little bit in the United States, up a whole lot more in Europe. We'll touch on that later. Up 4 or 5 basis points on a 10-year in America, 349. Crude softer, we talked about that. Euro dollar, not doing much today, 106.35, almost completely unchanged. Joining us now is Olga Kakova, the Deputy Director for Energy Security at the Atlantic Council Global Energy Center. Olga, I want to start with you on a story we talked about with Maria Tadeo, our colleague, about 40 minutes ago, and it was price caps in Europe. And you're looking at Hungary as an important case study. What are the lessons that you've learned from Hungary's experiment with trying to cap prices through this year?
So Hungary has had a gasoline price cap for about a year, and I think it's really important to take a look at what has happened and what did the price cap lead to. And basically, long story short, it led to the shortage of gasoline on the market. So I think we need to take that as a lesson and apply that to price caps when we talk about natural gas. As you're seeing, the leaders across Europe are trying to figure out what that ceiling for the price cap for natural gas will be. The original 275 proposal was criticized because initially it was not going to distort the market significantly. And in a way, that's a good thing because you're trying to attract additional LNG shipments. You're trying to attract more. This is a supply crisis. So, but right now, countries are saying, well, that is too high. We need to find ways to alleviate pressure on the consumers, on the industries. But, you know, there's other ways, of course, to do that. And price caps is one of them. And of course, the risk is that it could divert shipments to more lucrative markets, and it could also discourage efficiency measures and conservation.
Olga, the fact that you have European leaders coming together to negotiate something that could potentially not dampen demand, increase demand, and just exacerbate the problem ultimately, does that indicate to you, Olga, that there really is no solution right now that is plausible to refill the coffers ahead of next winter in Europe?
I think it just showcases that there isn't just one big solution that's going to fix this chronic supply crunch. And, you know, frankly, this started before this horrible war that kicked off in February 24th. This started last year around this time. Chronic underinvestment is what led to the situation partially. And of course, Putin took it to the extremes and truly exacerbated where Europe is right now. It also showcases the pressure that European leaders are under right now to provide some kind of answer, some kind of a solutions. As you know, you're right, there's uncertainty, first of all, around this winter, but most importantly, this is not just a one winter crisis. Next winter is really, really worrisome because there's really little information around how many shipments how much gas we will be able to get from Ukraine, from Russia to Europe. Also, you mentioned in an earlier story the increased demand in China and Asia. This year the reason why the storage levels are so high is because a lot of those Chinese shipments were diverted to Europe. With COVID restrictions loosening up, we can't anticipate the same scenario. So next winter is truly worrisome, and it's going to be a combination of demand destruction, efficiency measures, and really trying to ramp up those actual investments in the energy, both on the fossil side and on the renewable side.
This is kind of sensitive, but there has been a discussion about trying to lock in natural gas contracts from Qatar. As Europe tries to plan for a different kind of dependence on different alliances. How does the recent controversy in Brussels with the potential for bribery and some kind of scandal around giving certain perks to Qatar affect those discussions of using it as one of the main sources of natural gas, given their ability to produce it?
Look, I think the biggest lesson learned from the energy crisis is that energy does not exist in a vacuum. Energy and geopolitics and all of these other global events are so closely tied together, and we can't no longer ignore and put and treat them as separate sole issues, right? The other key lesson that we learned, it's all about diversification, so that when you do have these kinds of conflicts, these kinds of controversial things arise, you're not in a position where you're certainly relying just, you're switching from reliance on one supplier to another. The name of the game is diversification, having as many different options on the market. That way, if something happens with one of the players, you can go somewhere else. You can bump up supplies and pull those supplies from the market from somewhere else.
Olga, you've touched on the heart of the issue. It's not this winter, it's next winter. Given what you know right now, could you give us your best effort to describe what you think next winter is going to look like when it comes to energy in Europe?
I think it'll depend on several factors. Once again, how robustly, how quick the Asian demand will roar back. I think it'll also depend on if there are additional further attacks on critical energy infrastructure across Europe, because that could potentially take out some supplies. Let's take as that example, Norway's robust infrastructure. If there's anything that happens to that, that is going to take a huge amount of supplies to Europe off the market. It's all about the cold snaps this winter too. So you're thinking, how does this winter impact the next winter? It's all about how low the storage levels are once we come out in the spring, because the lower the storage levels are, the more Europe will have to backfill to get ready for the next winter, to get around that 100 BCM filled up. So all of these factors are playing in attention. I think also how well Europe does with its efficiency measures in demand destruction without destroying the industry, without hurting the household. So a combination of all of these factors is the answer here.
I get it. I know it's really, really complex, but I guess I'm just asking for your best guess. Based on what we experienced in the last 6 months, is it realistic expecting to go into next winter with storage levels where they were coming into this winter, without Nord Stream and without policies that really curtail demand?
So I'll give you my take. IEA put out this assessment that there's going to be potentially a 30 BCM shortage. I actually think that's on the more optimistic side, because I do think there's a lot of things that could happen that could, especially if we come out with lower storage going into the spring. I think that 30 BCM could actually be switched out into 40 and 50 and even more. Additional thing in that assessment that IEA did with the 30 BCM result, there was also assumed that the carryover from this year of the 10 BCM in industry destruction, which we don't want. We want the industry to continue working, and we really don't want to carry that over to next year. You want that economy to continue growing.
Yeah.
So if we were to translate that over again, that is not the end goal. So I would say, on the brighter side, let's take that IEA assessment, but I'm not feeling as optimistic. I would say there's a whole lot of room for additional shortages.
I think a lot of people share that view. Olga, thank you. Olga over there at the Atlantic Council, thank you very much. It's very, very difficult to make a call for 12 months from now. Think about the calls we were making 12 months ago, looking 12 months out, and how wrong they've been. War kicking off in Europe, energy crisis. Have we got through this winter okay? So far, so good, but teeing things up for next winter, not looking great.
It's even more difficult to make a call when it's hard to even understand what's going on right now, not only on the ground with supply and demand dynamics, but also just in general with policy.
You heard Olga just list the variables that go into a calculation like that. It was just going on and on. Emily Roden joins us next from John Hancock. Looking forward to that. Equity futures right now down by about 1% on the S&P 500. Live from New York City with Bramo. I'm Jonathan Ferro. TK's back Monday. This is Bloomberg.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Inflation has turned, but there is evidence that it is sticky.
We're now transitioning to this environment where central banks are divided over how do you wrestle with inflation rates.
For the ECB, for the Fed, it's all about real rates.
Central banks have kept interest rates too low for too long.
In some respects, I think the Fed's been dealt a better hand than the ECB.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
TK is so done with 2022, he's not shown up for work today. And good on him, because I agree. From New York City this morning, good morning for our audience worldwide. With Lisa Abramowitz, I'm Jonathan Farrow. Futures down by a little more than 1% on the S&P 500. It has been a week full of central bank speak.
And it hasn't gone the way that people thought. They thought that if they got a weaker than expected CPI, as we did, that it would mean that suddenly you'd get relief from central bankers who would say, actually, we're okay now, we can step down and we can consider whether we have to do that much more. And that was not what we got.
You know what we did get? Just a bit of a disconnect in the bond market with equities. Equities lower, treasuries up, yields down. That's a break. That's a break, and I wonder if that's setting the stage for what we might see going into 23.
Bonds are not buying what the Fed is selling. If you believe that the bond market is the smarter market, the more accurate market, then perhaps there will be a bigger reset in the economy. I don't know that they have any edge, though, on the Federal Reserve at this point, and a lot of people are just saying they're wrong, and this is just positioning. And also, it's a huge disconnect from what's going on over in Europe, where there is a reset.
Isn't that the recession trade starting to kick in? Isn't that a flavour? Just a little bit of a scent of a recession trade starting to kick in as well.
So the recession trade is kicking into the bond market, but not the stock market. And in the stock market, you have an increasing number of people coming on this show and saying the more likely outcome is you see resilience in the first half of next year. Because so far, companies are doing okay. They are still hiring. You are not seeing layoffs.
We saw Delta. Delta Airlines just saying, yeah, profits are going to be good going into year end. They're going to be better next year.
That's what we're hearing across the board. American Airlines actually increased the threshold for your miles. I have a feeling you're familiar with this. For your miles to get certain perks. And I was looking at that. You don't do that unless you have pricing power, unless you have the upper hand over your clients.
So we're spending a ton of time trying to look out to 2023. Can we talk about 2022 and where we are right now?
No.
I think where we are right now is really increasingly so difficult to understand. Retail sales yesterday down the most in 11 months. Slow down, right? Yeah. 45 minutes later, you got factory production decline for the first time since June. Slow down, all on board, okay. Then you look at jobless claims at around 200K. Hard to make the argument that we're seeing that labour market adjustment that this Fed chair would like to see, just based purely on jobless claims. in and around 200K.
How do you understand retail sales that look just at goods, where you're seeing the discounts, where you're seeing the disinflationary forces, but that don't include services, where you're seeing the jobs, where you have companies that want to hoard labor because they just had an experience where they couldn't hire people quickly enough, and they still see demand going up? It is such a complicated moment. Just added to all of this is the backdrop for oil, for energy prices, for gasoline prices that have fueled a feeling of ease. Again, a very difficult picture going into 2023.
A thing for this program this morning, that's for sure. Good morning to you. I just want to whip through the price action just briefly. On the S&P 500, we are lower. Futures are negative by about 1%. We're negative on the NASDAQ as well. In the bond market, yields are just a little bit higher, up by 5 basis points on a 10-year in America. I can tell you, up a whole lot more in Europe. On a 10-year in Italy, up another 18 basis points after moving 30 yesterday. And in Germany, can I just share the curve with you in Germany?
Please.
Twos out to tens in Germany. This is the move today, up another 11, you can call it 12 basis points on a German 2-year. Bramo, 245 on a 10-year, up another 10 or 11 basis points to 218. We've had a real sell-off in the European bond market.
Christine Lagarde, I would argue, was perhaps more direct than what we heard from Jay Powell.
Brutal.
A little bit more, maybe, I don't know. And she was just like, stop it, guys. Just stop it. We're not going to do it. How many times do I have to say this? How many languages do I have to do this? Well, we'll hear from more Fed officials today, and perhaps they'll be a little bit more direct. And that is what I'm actually curious to hear.
That's the tease for today. More
That's
Fed
it.
speak.
And I'm done. No, Fed speak. Let's talk about what it is. Fed President of the New York Federal Reserve, John Williams, will be joining at 8:30 a.m. along with Bloomberg's Kathleen Hayes. San Francisco Fed President Mary Daly at noon. Our own Michael McKee will be having a conversation with Cleveland Fed President Loretta Mester at 3:30 p.m. Look for the pushback, because that is what I'm expecting we will see. 9:45 a.m., the latest slew of data coming out. It's the only data that we're really getting of significance today. S&P Global U.S. Manufacturing and Services PMI for December. Do you get a 6th straight month of deceleration in terms of some of the activity here? And on Sunday, it is the World Cup, and it is what everybody just wants to get to so that they can be done with the week. France versus Argentina. Who's your favorite here?
I'm not making a call on this game.
Oh, come on, please.
I'm not participating. I'm a journalist without bias.
Oh, come on.
Come on, everyone believes that.
That's right. You have no interest whatsoever.
Coming up a little bit later this hour, Manus Cranny.
Totally punted.
From Doha. Looking forward to that conversation. And in the next segment, AMH and Maria Tadeo offering their critical analysis of how they think this game's going to play out on Sunday. And Maria not holding back over who she thinks is going to go home with the trophy. Joining us now, Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, fantastic to catch up with you, always is. I just want to pick up on a theme that I know you're drilling down on. The equity bond performance this week, Emily, you've picked up on it as well. What's it telling you?
It's actually pretty refreshing to see that diversification is working again. You have stocks down on the week, bonds up on the week, and that's the type of reaction that makes sense to us. Markets have almost been in this state of being comfortably numb, given the fact that central banks are implementing the most tightening that we've seen in a generation. The economic data are suggesting that a global recession is likely into 2023. The yield curve is wildly inverted to the tune of 78 basis points, and earnings are starting to come off. Those are all things to us that suggest that a recession is likely, and we've seen cyclical areas of the market showing leadership. We've seen European equities having their best quarter. They're one of their best quarters in years, and a lot of that cross-asset performance to us just hadn't been jiving with the macroeconomic backdrop. So we're starting to feel a little bit better that things are working as they should.
But Emily, this goes against this idea that perhaps we have to have a different playbook this time around. And this is what we've been talking about for a number of weeks now, that we're not necessarily going back to the pre-pandemic investment thesis where if something goes wrong, central banks lower rates and that fuels a risk rally. So does it make sense to you that the relationship between stocks and bonds is reverting back to something that it has been traditionally at a time when nothing about this moment is traditional?
Yeah, I mean, we think that the playbook is really, you got to still rely on history here. And we do think that given the fact that the economy is likely to contract next year, central banks ultimately will be cutting in the back half of next year. So we want to be positioned for that. We want to lean into bonds here. We like the idea that bonds are working in a portfolio. And Matt Miskin and I have been talking a lot about the fact that income is very attractive and very competitive versus other parts of the market. So we do think that that playbook comes through again. into next year, but it's going to take some time. The Fed has been incredibly just dogmatic in their approach to fighting inflation. We've heard it time and time again, but we know that the Fed is looking at lagging economic data, employment, inflation, especially services inflation. Many of your guests have talked about the fact that it's very, very sticky, and it's probably going to be too late for the Fed to really sort of reverse course quickly into next year. They're going to cause this economic slowdown, and then they're going to have to cut.
So Savita Subramanian, this is something that John has been talking about, really pointed out that there still is this feeling that if that is the playbook, then go into big tech. And that's what so many people are doing. And she pushes back against that and says that doesn't necessarily seem like the prudent play. Where do you feel on the leadership, on which are the stocks that can continue to drive upward some of the equity performance at a time if we're reverting back to a playbook that's familiar?
Yeah, I would agree. The playbook from a cross-asset perspective within equities might be a little bit different this time. It was always that, we looked to growth stocks. We wanted companies that were able to, produce that organic growth in a slowing backdrop. And now we're not really seeing that. A lot of the growth in technology stocks was pulled forward during the height of the pandemic. Think about all the stuff that we bought, whether it was online shopping or, conferencing tools or laptops for the kids. A lot of that growth and demand was pulled forward. And so we're seeing this period in which the baton is being handed over to the old economy. We look at the value side of the house, which is showing some resilience here. So we want to be thoughtful about where we're going in growth, where we're going in value. Areas like healthcare, one of our favorite sectors, very high quality, great balance sheets, cash on their balance sheets, organic growth drivers. But we also like your kind of classic S&P 500 tech companies, ones with a lot of cash. We don't want to own companies that need to tap the capital markets in order to grow. We don't want to own unprofitable technology companies in this environment, but some areas, carefully selected areas of the technology complex to us still make sense paired with value.
So Emily, one thing that you've said is that for the most part, equities are not acting like a recession is coming. Can I ask you where you would look for that and where you think we are further along in the adjustment process, perhaps relative to other parts of the equity market?
Yeah, it is so amazing to see this re-rating in stocks that began in the beginning of the quarter. We saw the S&P 500 start at 15 times forward earnings, and now we're trading at around 17 and a half, which means that stocks are now more expensive than their 20-year average. So we've seen this big re-rating, especially in more cyclical, economically sensitive areas of the market. Energy stocks doing better, even with oil prices coming down a bit. Pretty notable dynamic here. So we would look to find areas that are already priced for a recession. There aren't many. Matt and I have used the analogy of there's an equity store and a bond store for your Christmas shopping. And, the equity store, there's not very much on sale. Areas like mid-cap value stocks we like, they're trading at a steep discount already at 2008, 2009 levels. But the fixed income store, there's where a lot of the opportunity, where a lot of the bargains are. You look at investment grade corporate bonds, seeing this big price decline similar to 08, 09 levels. We like that. We like the income there, the total return potential. So again, favoring the bond store over the equity store during this holiday shopping season.
Remember when you were a kid and your parents would say, you can't get anything from there, and that's where you wanted to shop. It was the toys. They're expensive.
Tell me more, John.
And then your parents came along and said, you've got to get that. You need a new coat. I feel like that's what Emily Rowland's telling me right now. It's like, don't look at stocks. Go to the bond store. Who wants to shop at the bond store? No one's wanted to shop there for 10 years.
Okay, what was the most disappointing gift you've ever gotten?
When I was a kid, I didn't like getting clothes. I was very against clothes. And I remember my nan turning around to me and saying, John, in 20 years' time, this is all you'll want. You'll just want nice clothes. You won't want toys. And I was like, yeah, but I'm not,
But I'm still this age.
I'm not 30 now.
Let me be there.
I don't want clothes, God bless her.
So please, if you're listening, no clothes.
Love clothes now. Love clothes
Depends.
now. Although I was thinking the other day, you know what? I'd love a toy car for this Christmas. Just a remote-controlled one. I'd love that. I'm actually thinking. I'm thinking about buying one for the apartment.
You absolutely are trolling.
I'm serious.
Somebody.
I'm thinking about buying one for the apartment. I want like a toy Ferrari, like a Formula One car with a remote control.
You build like a little set.
Because when I was a kid and I had a toy car, it had that cable attached to it. Do you remember that? And you had to sort of follow it because it wasn't remote control.
You want like a real one.
I want a proper one, like a really fast one. I'm going to go out into Central Park with Tom and play with it. We never said thanks to Emily. Emily, thank you. Have a wonderful Christmas. Equity futures down 1%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Russia has launched another large-scale missile attack on Ukraine. Several cities have been hit, including the capital, Kyiv. Widespread power outages have been reported. The attack comes a day after a top Ukrainian army commander warned that there's no doubt Russian forces will try to seize Kyiv as soon as next month. A Russian assault in the spring failed. In Beijing, a rapidly spreading COVID outbreak has turned the Chinese capital into a virtual ghost town. That underscores the cost of President Xi Jinping's sudden pivot away from COVID zero. Anecdotal evidence suggests entire families and offices in Beijing have become infected in the span of just days. That could be a preview of what the rest of China faces. Boeing is closing in on an order for as many as 200 of its 737 MAX jets from Air India's new owner, Tata Group. Bloomberg's learned the two sides are trying to wrap up talks before the holidays. Tata is working on rebuilding the formerly state-run airline. And workers at 50 Starbucks locations in the U.S. are starting a 3-day strike today. They say the company isn't bargaining fairly with stores that have recently unionized. The labor group, called Starbucks Workers United, has prevailed in elections at about 270 Starbucks stores this year. The company says it hasn't engaged in anti-union activity. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
The secret of success of any company is to grow. And I think that we, WPP, and our industry more broadly, can be really at the heart of a client's growth. You know, how do they succeed with consumers? How do they reach them in new areas? How do they innovate? How do they create new brands?
Central banks have kept interest rates too low for too long. The problem with the Bank of England and the ECB is policy rates are nowhere near restrictive, so time cannot substitute for that.
John Riding there with a really important point from Breen Capital Chief Economic Advisor over there. Bramo, I think Tom just stopped in his tracks yesterday when he heard that. Time cannot substitute for that. He does not think rates are restrictive. And I think phrase of the week is sufficiently restrictive. We heard that from the ECB yesterday, and you heard that from Chairman Powell repeatedly in the news conference. Some people think these terminal rates that they're looking at, the ECB, the Federal Reserve, are unachievable. John sat there and basically said what they're projecting still is not restrictive enough.
Okay, first of all, sufficiently restrictive is another one of those phrases where you can make it mean whatever you want. So, of course, they come up with some phrase that sounds good, that they can kind of fit into a box that really can mean anything. With respect to his point, it is a salient one because a lot of people have said, even if the Fed doesn't raise rates that much more from here, but holds them for a year, that's going to be more restrictive because of what you've pointed out. If economic activity goes down, it's not...
policy, by definition, gets tighter.
Exactly. So, I mean, that's the key question. Does time make a difference?
If inflation, if indeed it does roll over in the way that people expect, I still think that the question of the week came from Bob Michael over at JP Morgan when he said the recent disinflation, is that transitory? something we've got to think about going into next year. And clearly Christine Lagarde is not happy with the subtle improvement that this market's jumped on when it comes to Eurozone inflation. We've still got double-digit CPI in the Eurozone. And there was a moment yesterday where she delivered a compare and contrast between the Federal Reserve and the ECB, where she almost said it, and she basically did say, we are not the Fed. We have so much more work to do here. And I thought that was interesting.
I would also argue the idea of what Bob Michael said, that disinflation is transitory. If you look at the underlying components, used cars, even some of the housing markets, you can see that it's not such a clear line down. So even if you tear apart some of the components, it's not a very clear disinflation story for a very long time.
Well, Europe and the Eurozone specifically has a big difference when it comes to the United States and European economy. Europe has a war on its doorstep. Russian missiles knocking out power across Ukraine. Let's get to AMH in Washington and Maria Tadeo in Brussels. Maria, can you give us an update on what's been taking place over the last couple of days?
Well, Jonathan, you see that this is now a drone war, and we've talked about the changing nature of the war in Ukraine. It started very hard on the ground. Then, of course, Russia suffered losses, retreated, and then began to target critical infrastructure, energy infrastructure. Their hope is that at one point, it's the Ukrainian people in minus temperatures that will ask President Zelensky for a compromise. But for the time being, that has not happened. And every Ukrainian official that I've spoken with behind the scenes says the country has never been more united in this fight. Now, the other issue, of course, that is still going on is Ukraine asking for both more air defense systems, long-range weapons. We know for some that is scary. They worry about open confrontation in Russian soil. And then yesterday night, Jonathan, I know from a good source, the President Volodymyr Zelensky, he asked the Europeans to provide tanks. And he said at this point, there is no rational reason not to provide tanks. The Ukrainian leadership is tired of this debate of offensive and defensive weapons. But as you know, there is a debate at NATO as to how far you can give weapons before you become belligerent yourself.
And Maria, on the U.S. side, you're seeing the defense budget increased materially. How much more could it go given the ongoing turmoil of the war and the sense, this commitment by Europe to keep the resolution?
This is so much more money than the Biden administration had asked for, and this is likely why you're also seeing a lot of Republican leaders in the Senate willing to go with a spending budget for the whole year because they got a lot of what they wanted on the defense budget. So what you're seeing is millions of dollars of funding to Ukraine. Also, you're seeing more money going to Taiwan. But there is also a lot of questions and risk for the U.S. military in terms of what happens if, say, the U.S. had to defend itself, say they had to go to an ally's help to defend itself. The supply chain, speeding up all this is incredibly important because they had to lower their stock because they are sending so much over to Ukraine. The real focus in Washington is, of course, is whether or not we are going to get that announcement and if President Biden is going to sign off on sending those Patriot missiles over to Ukraine. That is something that President Zelensky wants to see, has been asking for, and has hinted that he thinks it's coming.
Maria, when we talk about European unity, perhaps there is some on lowering oil prices or natural gas prices, although how to do it, of course, remains in question. What's been the reception like to what Christine Lagarde was talking about yesterday? A very hawkish message, basically saying that they have to make policy restrictive and they're going to jack up borrowing costs.
Listen, I have this thing every time after a European central bank decision, I look at the German press and then I look at the Italian press. This is the thing that I do on the Friday morning to see how that decision went down. And it tells you everything you need to know. I was looking at the Italian press today. There are some words in Italian that I probably cannot say on international TV, but this has not gone down well. Essentially, the message is the Hawks are in control. Christine Lagarde is completely now on their side. This puts Italy in a very difficult situation. Senior ministers, by the way, Italian ministers, openly criticizing that decision, the language yesterday on Twitter. And just one thing, finally, and this tells you a lot. Yesterday, Giorgia Meloni, who was here in Brussels when the meeting was over, decided she would leave and would not take questions. So that tells you a lot about the room and the temperature after that ECB decision yesterday.
The Italians, of course, also deeply unhappy that France is in the World Cup final on Sunday, Bramo, and The Italians aren't there.
What gives you the authority to speak about that,
Well,
John?
being half Italian myself and
being
a deeply passionate supporter of the team.
How do you feel about this? Are you still going to be watching?
Perhaps share that sentiment. I will maybe tune in on Sunday for the second half.
Consult?
I'll go to church first, then come back for the second half.
Oh, you're going to do that?
Maybe
You're going to go to church
maybe
first?
catch 20 minutes.
Really?
Yeah.
Are you going to be checking the scores the entire time?
Just going to pray for the Italian national team in the next World Cup.
Exactly, clearly.
Maria, it's your moment. World Cup winner Sunday. Who is it?
Look, everyone has asked me this question, but before we get to that, I have to say two things. First of all, when you get to a final, it's congratulations to both teams. I mean, this is the Olympus of football. It means you've done incredibly well. You should be proud. The French, they have a 23-year-old who's going to be a star. No, the other point I want to say, of course, football, what a game it is. It brings everyone together, and what a beautiful game it is. But if you ask me, who is my team? I'm Spanish. Latin America is in our hearts. This is a relationship going back centuries, history, language. So my World Cup winner is obviously Argentina. Argentina, go win on Sunday. A ganar.
So that's not real analysis. That's just about sort of deeply passionate, sort of home bias.
It's my analysis.
As opposed
it's
to...
a form of my analysis.
I'm not saying I'm providing any real analysis.
I was supposed to. My heart is with the Italian team.
Of course, no,
it always,
it always is.
Go to church and pray for them.
AMH, final word goes to you.
I'm going for the French, Lele Bleu, and I also have a personal connection I can go through. I have a French grandmother, the Goulets. They would be very upset if I wasn't voting for the French. We always go for the Italians, obviously the Americans first. I'm an American citizen. But if not, I'm going to go for the French, and also they have the track record. They are the reigning champs. And I love seeing Mbappe play.
I'm going to provide actual analysis.
You're going to provide real analysis. Okay.
I think that this has been about the legacy of the past that still is the current and the future, right? It's going to be an Mbappe versus a Messi game in the passing of the torch. And I think that that's going to be a fascinating matchup, and also the defense of Mbappe and how that sort of plays out.
That was beautiful promotion.
Yeah.
Sunday's game.
She's been watching. You've been watching this game.
I have. It's been really fun.
You've enjoyed this. Really good. You know, FIFA's about to screw it up and change the format at the next World Cup.
What do you mean?
They want to introduce more teams
don't get me
into
started.
the World Cup, and they want to change the format. They were flirting with the idea of maybe having groups of 3 and not groups of 4. Now they realise that's probably not a good idea. Now they're talking about two halves with a load of groups of 4 on the one half and a load of groups of 4 on the other half.
People hate FIFA. Why do they keep doing that? I mean, for a load of reasons. And they said that this was going to be a really unsuccessful World Cup. And from a drama of the games perspective, it has been incredibly successful. From many other perspectives, incredibly controversial, with a lot of people wondering whether it's even worth attending. And you've seen certain stadiums that have not been completely full.
The kinder interpretation is that they want more nations involved. The more cynical
more
view
money.
is that it's about more money. And that's what's frustrating. Look, am I unhappy that Italy wasn't there this time around? Absolutely. But you're not entitled to a place at a World Cup. You're not entitled to a place there. And I think this format has stood the test of time now. And it's fantastic. And everyone's sort of engaged in it, understands it. It's coming to North America. There is a familiarity with it, increasingly so over the last decade. Why would you change the format going into 2026?
I wonder if there's more impunity at this point, because a lot of people protested the Qatar hosting, and even the moving of the timing of the World Cup didn't seem to really make a dent in terms of viewership.
This is not the end of our World Cup coverage. I understand Manus Granny's coming up from Doha, so we can continue the conversation.
There's going to be no one watching.
Looking forward to that. Sabadra Japa coming up from SocGen. Sabadra's got some really strong thoughts on the German bond market. Looking forward to that. She thinks it's still a sell. That's up next. So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Down 1% on the week, down another 1% on the session. Live from New York, about 2 hours away from the opening bell. Here's the price action for you. Equity futures soft and negative lower, down by a little bit more. On the S&P 500, futures are off by a little more than 1%. Looking at NASDAQ futures right now, negative by 0.7%. That's the equity story. Here's the bond market price action. 2s, 10s and 30s. Yields just a little bit higher at the long end on 10s by, let's call it 5 basis points to let's call it 350 on a 10-year, on a 2-year, 425. And remarkably stable over the last couple of days. I've got to say, even in the face of a vicious sell-off in Europe. We can finish on the European bond market. Bunds up yesterday, flying. Up again today by 11 basis points. The Italian 10-year was up 30 basis points yesterday. It's up another 17, 4.34% on a 10-year. QT is about to commence. QT light, maybe in early 23, but the pushback on rates and the rate path through 23 from President Lagarde was so firm. No ifs, no buts, no maybes. No on the one hand this, on the other hand that. Just really forceful language from President Lagarde, even going into the tail end of that news conference.
Which is why you saw the biggest sell-off by one measure in the German 2-year going back to 2008. Maria Tadeo, I thought, was really interesting, talking about the Italian finance minister.
Unhappy.
Not exactly thrilled.
They're not going to be.
No, I mean, at a certain point, especially if you're heading into a downturn. Just to walk through some of the stocks that are moving today, if anyone is out there looking at anything other than just taking vacation. American Airlines, which might get you there, actually came out and tightened up their frequent flyer status and their loyalty programs, which ballooned. And so they raised the threshold to really come into some of the perks. And John, I thought you'd care about this. It's down more than 1%, but it also really is not the only one. There are a host of airlines that are doing this. This does not indicate that they're concerned about demand if they can do this.
I can tell you, to get status at American is actually really difficult. You need to fly a lot. The bar is not low compared to something like, say, United, where I've noticed the bar is exceptionally low to get status.
But they're actually tightening it up even further from there, and it's because they don't want the crowding, they don't want to lose the revenues, and they don't have to. Again, that's what I find interesting.
So the crowding where? At the check-in? It's the check-in crowding they don't like? Is it the check-in in the lounges that they don't like? What is it?
It's part of the earlier boarding, the free upgrades, the idea of having all of the perks. It's basically pay more, get less. I mean, that's basically what my interpretation of the airline industry.
They want to make it more exclusive?
Yeah.
Okay.
That's, I guess, what some people would like to see. Amazon falling after JP Morgan cut its price target on the stock to $130 from $145. Part of this has to do with the cloud, AWS, but part of this also just has to do with margin compression, and we've seen this across the board. And Meta is surging, shockingly, given how the rest of the tech universe is doing, almost 2%, as JP Morgan raised its recommendation on the stock to overweight. Cost discipline.
That's the story. Discipline's back. 2023. You wonder how these tech names are going to adjust to it. We're already seeing it from Meta. You mentioned Amazon. I wonder if Jassy makes a bigger push there as well through next year.
If people actually have to turn up in suits.
I'm not saying they should all wear suits. I'm just saying, it'd be nice if, I think defining the last decade of zero rates and QE is Zuckerberg going around with a hoodie on a roadshow. In those days are over.
I would agree with that, and you're seeing that in the layoff numbers that we're seeing from some of the tech companies.
Big time. Let's get to Subhadra Japa, head of US rate strategy at SocGen. Subhadra, your quote from your piece last night, can I say it was great, by the way. I had a good read of it. Powell stuck to his script of higher for longer after delivering a 50 basis point hike. A hawkish shift in the dot plot failed to nudge yields higher. You went on to say, though, and I think this is real pushback from the consensus view going into 23, we expect a modest rise in yields in Q1 as central banks deliver more hikes. Subhadra, can we start there? What do you think other people are missing going into next year?
Well, I think the price action right now is not reflective of what we should expect next year. You're getting into the year end, liquidity is very poor, people are paring back positions. But you're looking at, the Bank of England, poised to deliver another 50 basis point rate hike. The ECB's, perhaps going to deliver another 50 basis point rate hike.
So global central banks, broadly speaking, are still going to remain somewhat hawkish for at least the first quarter to first half of next year. So under those circumstances, I don't see why yields can't adjust modestly here. I'm not calling for significantly higher yields, but I think if you get towards maybe 3.75 or 4%, that's not necessarily out of the realm of reason. I feel like the market is, especially 10 yields, are very rich as they stand right now.
At 350, so can we talk about the front end as well, just so I can get a better idea of where you think the curve is going to be, how you think that's going to evolve next year too? Right now, 425. How are you thinking about that, Subhadra?
Well, I don't think the front end has a lot more room to rise unless we expect the Fed to hike beyond 5.25%. But on the long end, the dynamics are very different. You're going to see a lot of corporate issuance come into the market. You're going to see perhaps more even treasury issuance. Typically, those tend to at least support a little bit of a bearish momentum. To that, add the fact that I think bonds have more yields, so bond yields have more room to rise. I think that 10-year yields could see a push higher, at least in the first quarter, before we start seeing yields decline in the second half.
Subhadra, I completely buy what you're saying. So does the Federal Reserve. This is what the Fed is basically telling the market is going to happen. Why are so many people pushing back?
I think there's a concern about a recession in the U.S. To me, those concerns are a little bit premature. At SocGen, we have a little bit of an out of consensus view on the recession in the U.S. We think that's an early 2024 event. It's not a 2023 event. So my real concern is that the market is not fully appreciating the fact that come middle of next year, if the unemployment rate is not heading towards 4%, we're still stuck at, say, 3.7, 3.8, and wages are still pretty strong, the Fed might have to go beyond 5.25. I'm not saying that that's our base case scenario, but that's a risk scenario that the market is not fully appreciating.
What's your base scenario, Subhadra, of how long it will take to get back to 2% inflation, given what the Fed has already signaled?
I mean, we got the summary of economic projections from the Fed. The Fed doesn't expect inflation to get to 2% in 2025. So you're looking at a very strong trajectory towards inflation remaining sticky after that initial descent. Now we're rejoicing the initial descent, but what if we get to maybe 3% or 3.5%, and then inflation stays there and it's sticky at that level? At that point, I think the Fed is still going to remain somewhat hawkish if the employment picture is relatively strong. And there's a good chance that the employment picture remains relatively strong, given the fact that we have such a mismatch in the labor market between job openings and available employees to fill those jobs. So I'm not saying that the labor market is going to be as tight as it is right now next year, but I think it could potentially take a lot longer for the employment picture to weaken meaningfully from here on.
Emily Rowland was speaking earlier about the fixed income shop. There's a fixed income shop, and then there's the stock shop. And the fixed income shop has a lot of good things in it, including investment grade debt, because of how much it has been sold off. That has been on rate story, though, not necessarily the credit side of things. Given your projection that we might not get back down to 2% inflation based on what the Fed is looking at themselves by 2025, does that default rate kind of expectation, does that premium have to rise substantially from where we are right now?
Our corporate strategists don't think the default rates rise in this cycle. I think we're in a very different environment, relative to the 2008 timeframe or the great financial crisis. I think companies are in a very good spot. One metric that we look at for recessions is corporate profit margins. Corporate profit margins are still very, very healthy. So for the most part, under those circumstances, it's really hard to envision a scenario where the default rates are going to rise meaningfully from here on. So I think the corporate sector is relatively robust. If we get a lot of supply next year, we're expecting a decent amount of demand from a variety of investors, because the yield you get for holding U.S. bonds is quite substantial relative to yields in other regions. So I think for the most part, this is going to be a bond story next year, and it's going to be for yield and return.
Subhadra, just one final question. What pivot? This was the title that came from the team at SocGen. The jumbo rate hikes are over, but we are far away from a monetary policy pivot. Can we just end on where you see terminal rates? Just around this, I think that's a headline for a lot of people. Where's the terminal rate at the Fed? Where's the terminal rate at the ECB? Is it basically in line with what's being priced right now?
So for the Fed, I think the market and the Fed are well aligned. I mean, I think the market expects the terminal Fed funds rate maybe around 5.25%. Maybe it's a little bit underpriced right now for next year, but not by a lot. For the ECB, I think there's still a lot more room for the market pricing to rise higher. Our economists in Europe, now expect the ECB to raise rates to 3.75%. Wow. I don't think that that's fully, priced into the European bond markets. So that's why we see more potential for the Treasury bond spread to narrow. I mean, it's when we put out our outlook, we had the 10-year Treasury bond spread around 175. We were calling for it to come to around 115. Guess what? This morning we're already at 130, and we still see more room for that Treasury bond spread to narrow. So I think that it's quite hawkish for the ECB. We see more room for bond yields to rise relative to Treasuries.
I just never ever thought they'd go this far. No way. Not even 9 months ago, 6 months ago. Never thought they'd go this far. Subhadra, thank you. Wonderful summary of the last week or so, looking ahead to 23 as well. Subhadra Chapra of SocGen. Always instructive to have a look at which war the doves are fighting right now. Mario Centeno at the ECB out of Portugal saying there's a low chance of rate hikes returning to 75 basis points. That's the fight they're having. They're basically trying to say, yeah, no more 75s, but I guess we've got to live with 50s. That's where the ECB's at.
In other words, if you want to put this another way, everyone's a hawk. And the most dovish you get is just simply fighting some of the biggest rate hikes that you've seen in history. When you say you never thought we'd get here, we never thought we would get off zero. Remember all those conversations when people were saying, you're never going to see positive interest rates in the euro region ever again. How much confidence do central bankers get from the fact that you do not see a default cycle? Subhadra was not saying that necessarily we're going to see that in the U.S. Europe, though, there is a question, perhaps a little bit more, especially with companies having issued debt at negative yields effectively, what that looks like when they have to refinance.
You've got to remember that Mario Draghi never hiked interest rates in 8 years at the ECB. So it wasn't unusual to make that call basically after what we've seen over the last decade. I remember in the depths of the pandemic to make that call, it seemed kind of logical, intuitive even. Looking ahead, can the ECB hike interest rates? Probably not. Then inflation came through hard, and this ECB's had to adjust quickly.
But this goes back to what I was talking about with Howard Marks when he was saying that it's a sea change. This is a new environment, which raises a real issue with this idea that people have that we're going back to the playbook that worked last year, 2 years ago, 3 years ago, when cutting rates was the response. Is that still the response if the poison is inflation, not disinflation?
Talking about the poison, have you seen this from Semaphore? Goldman Sachs, according to them, set to lay off as many as 4,000 people as the cost of its ambitious push onto Main Street takes a toll. I'll dig into that story for you, and we'll pick up on the details of it in just a moment. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Two top Democrats say President Biden should run for re-election in 2024. In an interview with CNN, House Speaker Nancy Pelosi said Biden has been a great president, while Senate Majority Leader Chuck Schumer said he would support Biden all the way. The backing comes as some Democrats urge the party to look for a younger generation of leaders. At 80 years old, Biden is the oldest U.S. president to hold office. Members of the European Union have reached a deal on a 9th package of sanctions on Russia. They target Moscow's access to drones, more banks, and officials said to be responsible for kidnapping children from Ukraine. They are also export restrictions on chemicals and technologies used for military purposes. In Peru, more nationwide protests sparked by political turmoil. A judge has ordered that former President Pedro Castillo remain in custody for 18 months while he's investigated for alleged crimes of rebellion and conspiracy against the state. Demonstrators have demanded his release and new presidential elections. Private equity firm Advent International has agreed to buy satellite owner and weather forecaster Maxar for about $4 billion. Shares of Maxar more than doubled in pre-market trading, including debt. The transaction is worth about $6.4 billion. And Amazon has signed a deal with Games Workshop to develop movie and TV productions, starting with its popular Warhammer 40,000 franchise. And Warhammer is a sci-fi universe focusing on themes of conflict and galaxy-spanning empire. The franchise includes a popular video and tabletop games and more than 300 novels. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation to start falling more rapidly, probably from the late spring onwards. But there is a risk that it won't happen in that way, particularly because the labour market and the labour supply in this country is so tight. And that's why, really, we have to raise interest rates today, because we see that risk as really quite pronounced.
Governor Bailey of the Bank of England looking ahead to 2023 and the potential to do even more. Looking at equity futures right now, down about 1% on the S&P 500. Weakness yesterday bleeds through into Friday. We're down across the board. In the bond market, yields just a little bit higher by 4 or 5 basis points on a 10-year 349, euro dollar unchanged at 106.26. Let's get to Goldman and look at a stock right now in the pre-market. This from Semaphore. I'm going to share this reporting from them with you and read it verbatim. Goldman Sachs plans to lay off as many as 4,000 employees as it struggles to meet profitability targets and retreats from its gamble on Main Street banking, according to people familiar with the matter. The story goes on to read, managers across the firm have been asked to identify low performers for what could be a cut of up to 8% to its workforce early next year. Now, Lisa, I have to say, when I first saw that number, I thought they'd accidentally put an extra zero on the number, because earlier this week, our own reporting indicated that they were looking to lay off maybe up to 400 people, but the latest from Semaphore, that's pretty dramatic stuff from Goldman Sachs, if that's right.
Talking about 8% of the staff. I mean, this is a significant layoff, and it comes as there have been a lot of questions around CEO David Solomon's quest for profitability. He fell short of that goal that he set in February. Really, the targeting of the Marcus unit is one of the big questions that we have yet to understand. How much is this going to be isolated there versus a broader culling, especially in light of some of the slowdown that we've seen in deal making and capital markets activity?
Just going further through this reporting, it goes on to read, in a typical year, between 2 and 5% of Goldman's employees are laid off or receive no bonus, zeroed out in industry parlance, a clear sign to start looking for another job. Like other firms on Wall Street, Goldman skipped those cullings in 20 because the pandemic made them insensitive, and 2021 because boom time profits made them unnecessary. So if we can walk away, just step back from the Goldman story just for a moment. When we look at big tech right now and the financials, how much of this is just kind of, I don't like the phrase payback, but is that what we're making up for because of what hasn't taken place in the last couple of years?
And that's what we saw at Morgan Stanley, because Morgan Stanley also had reports about cutting some of the staff, and it was bigger than expected, but it was just a fraction of the number of employees that it has over where it was pre-pandemic. So to your point, this is the reason why some of the layoffs that we're hearing about may not be indicative of a wholesale retrenchment in the employment market, but rather areas that got, I don't want to say overstaffed, but overstaffed during the pandemic.
Goldman stock right now down about 1%. We're going to try and get Sonali Basak on the phone, our Wall Street correspondent, in just a moment. We've got to head over to Doha as well. The World Cup final in just a couple of days. Argentina versus France for football's ultimate prize. Manus Cranny holding a football. He joins us right now outside LaSalle Stadium. Manus, walk me through how big the next 48 hours is going to be.
It's going to be monster. It is going to be monster. They spent $45 billion. I never understand what $45 billion looks like. Let me show you. There you go. We're at LaSalle. That is a capacity of 88,000. Argentina is adding 2 extra flights to get their people here. Depends which hotel you stay in, and I'm not in the Four Seasons, let me add. I'm on the periphery, but I play in the center. Excuse the pun. So I've been downtown, and it's a pretty cool atmosphere, I gotta say. I'm out of my inner Bond guy is gone, and they've given me a ball to play with. This is Rogue.
Manus, is that a regular size ball? Because it looks like it's a bit smaller than previous balls.
I want you to know that we've spent the sum total of 60 reals on this.
Okay.
We couldn't afford,
all right.
We couldn't afford the big ball.
All right, great props. I like it. I'm curious about what the reception has been like in Doha when it comes to whether this was a success or not. What's your view?
I think if you judge it by dollars spent, viewers, numbers, the most watched game in the United States of America for soccer, it's football. For football in the U.S. was U.S.-England, the most watched soccer game ever. So has it been, a ramping velocity success for FIFA? Yes, $7.5 billion, breaking news now. That's what they've earned over this Qatar 2022 World Cup. So dollars spent, yes. Reputation, that is a whole other bandwidth. You can look at it from your side of the pond, which is about LGBTQ rights, labor workers' rights. You can also look at it from my prism, where I am here in Qatar. The Saudis came and visited. They were all hugging up one another. Mohammed bin Salman, the Al Thanis, a real rapprochement of the GCC. So it depends which prism you look at.
Manus, I miss you, buddy, so much. So much. And can I just say, can I make this statement? Someone get Cranny a ticket for the final. Do you know he doesn't have a ticket for the final?
And he's not staying at the Four Seasons?
He's there for the weekend. They've got to sort it out for you, Cranny. Good to see you, buddy, as always. Manus Cranny.
This is the worst expenses trip I've ever been on.
In Doha. Almost complaining there. I think he was pretty upfront about complaining there, wasn't he?
Yeah, yes.
2 days away.
That's okay.
Has it been successful relative to the amount of criticism it got coming into it? I think a lot of people might say yes. The football has been successful.
The football has been successful. The amount of money they have taken in versus spent, not so much, a little disproportionate. And with respect to whether it actually emboldened the nation or gave it a better reputation globally, not sure that can really be conclusive either.
I want to get back to that breaking news, that story from Semaphore a little bit earlier on, 5-10 minutes ago. Goldman Sachs planning to lay off up to 4,000 people. Sonali Basak's jumped on the phone for us. Sonali, I assume you've read through the story as well. What do you make of these headlines that have dropped in the last couple of minutes?
Yeah, 8% is what this would amount to, according to Semaphore. That's about 4,000 people or so. Listen, remember, if you put this in a comparison, for example, what you saw at Morgan Stanley's percentage cut was about 2%. I'd say Goldman has expanded pretty drastically over a set of acquisitions and hiring over the last couple of years. We talked to David Solomon just a week ago, and he hinted that pruning would happen. So this puts a number on how deep pruning goes, thousands, not hundreds. This will go into early next year, according to Semaphore. So this is in addition to the cuts we've already seen. Remember, if Goldman is doing this, you have to assume that other people are already also starting to think about whether it's time to start cutting some jobs after massive headcount increases the last couple of years. it's kind of very classic Wall Street behavior, isn't it? Hire a lot in the good times, and then before things get bad is when you start to prune.
Shonali, there's a real question, especially around Goldman Sachs, about whether this is going to be concentrated in the consumer-facing business, the Marcus operations, or whether it will be broad-based, including some of the investment banking units that have been incredibly successful. What's your sense, based on your conversations with leadership there?
So listen, it's the conversation we had in good times was whether you want to put money towards technology or whether you want to put money towards people. And that conversation gets even more significant in bad times. So even at a trading desk, for example, my question would be for Goldman is, when you put that marginal dollar to work, are you going to put it to work at a star trader, or are you going to automate your processes more in fixed income or other places? That is the strategic decision you have to make in a hard time into next year while you're protecting your margins. And by the way, one may pay off more than the other. And so you have to assume that low performers across every business line are going to be taken a look at. And yeah, this is not going to be, from my understanding, just dedicated to Marcus. Although remember, they did buy that business, Green Sky, in that consumer business that added 1,000 or so people in the last year.
Shonali, we've got about a minute left. Let's just take a step back. You caught up with the CEO of Goldman only a couple of weeks ago. Was there any indication of this, just thinking back to that conversation, any indication whatsoever that something like this was coming?
Totally. It was 1 week ago, John. I know this year is going really fast. But he did say, he said more pruning would be likely to come. And again, the 8%, you have to think about it in perspective here. It is more than what we're seeing at Morgan Stanley. It's more than what we have seen announced at Citigroup or Barclays. But it has to be a harbinger of things to come here on Wall Street, which is why people pay so much attention to Goldman at this time.
We'll see if the firm confirms the effort a little bit later this morning. Shonali Vasak at Bloomberg. Shonali, thanks for jumping on the phone. We'll catch up with you a little bit later. Brahma, what do you make of that in the last 10 minutes?
How unique Goldman Sachs is versus representative of the broader Wall Street trend. That's the real issue for me, is how much is this representing a lack of an ability to reach profitability targets, which a lot of people have raised a lot of questions about, including investors, versus something that is just more wholesale, having to do with the environment, especially after how much they've beefed up. Again, though, you have to imagine deal making is going to slow a lot, and that's going to create a lot of pressure.
Well, it has done this year, hasn't it?
Yeah, it has. And is it going to really increase that much? I mean, this all goes back to that rates picture. If rates stay where they are, how many companies are going to want to refinance or make acquisitions?
The latest from the news organization Semaphore. Goldman Sachs set to cut as many as 4,000 workers. Their stock is down by about 1%. Coming up, looking ahead to 23, Sam Stovall of CFRA from New York. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change? I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and footprint of the organization.
So what can you do near term?
test to make sure, you see, at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're going into this environment of slower hikes, fewer hikes.
It's not a question just of how fast we raise rates. That's a lesser important question now. It's how high and how long are we going to keep it there?
I think for the time being, they're very much focused on inflation.
If we are going to see inflation falling back, it is going to be very much a challenge that is going to have to be met by probably a more aggressive policy reaction.
We believe that early next year, the market will realize that inflation is sticky.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK back with us on Monday. He's taken a long weekend. We need to pick up with that Goldman news from 10 minutes ago. Goldman Sachs, according to Semaphore, could cut as many as 4,000 workers. And I have to say, Lisa, I've got to repeat what I said 5 minutes ago. I thought they'd accidentally put an extra zero on, because we reported earlier this week the number might be 400. 4,000 is way above what we were looking for.
And I'm going to repeat what you just said a minute ago as well, and just say that there's a question about whether this is idiosyncratic to Goldman Sachs, idiosyncratic to the banking industry, or if this represents something broader, especially because the banking system usually is a bellwether of what's to come. And a lot of people have been saying these are the areas that built up their staffs disproportionately, did not make cuts during the pandemic. So perhaps they have more to cut, but it doesn't represent weakness in the labor market that a lot of people are looking for.
8% of the bank's workforce, that's the number. Got to see if Goldman confirm any of this morning, going into the weekend, coming out the other side, because that's a big report. That's a very, very large number to put out there.
But our own reporting earlier this week indicated some cuts at a magnitude much lower than that, but some cuts at Goldman Sachs. We've reported on also a magnitude much lower over at Morgan Stanley. It's clear that there is a different tone on Wall Street, especially as the deal-making operation grinds to a bit of more halt. I mean, even the mortgage operations. Can you imagine what a mortgage banker is doing right now?
I know, it's tough. It's so difficult. If you go through the Semaphore piece, it's interesting. It's not just about the business environment, it's about the past. And that wasn't just about the hiring, it was about the fact that they weren't laying off the people in the way they typically would. Because of the optics of doing so, given the economy that we're in at the time, with the backdrop being we're still in a pandemic. It's fascinating to see how the last couple of years have played out, and ultimately how it's going to play out now because of that through the next 12 months.
We're seeing that with respect to layoffs at the tech companies as well. Where we're not seeing that are the areas that did lay off in mass. A lot of workers are shut down in the services sector when those services disappeared, when in terms of people just staying home. And now there still is that hiring. This is why it's such a complicated moment to understand the tightness or looseness in the labor market.
So are we normalizing? Is that the right way to look at this? Are we normalizing in places like Goldman? When you go through that piece and they talk about the fact of what they used to do. What they used to do in a typical year is 2 and 5% of Goldman's employees are laid off or receive no bonus, and they haven't done that in the last couple of years. Could you say this is normalizing?
Maybe. There's nothing about this moment that's normal.
There's
It's
nothing
very
about
difficult.
that number that's
exactly.
normal. Let's be clear
So
about that.
I don't know that I can say that it's normalizing. Perhaps we're getting back to a new normal that we're establishing through a pretty rough process.
In about 25 minutes, we'll catch up with the Fed's view on all of this, because John Williams of the New York Fed's going to be speaking to Bloomberg's Kathleen Hayes. That kicks off the Fed speak that you've all been waiting for. Did you say Mesters with Mike McKee a little bit later this afternoon?
3:30 p.m.
Looking forward to that. Mary Daly, the San Francisco Fed, in the mix as well. You wonder if they're a little bit more blunt in a way that Chairman Powell was not, or whether we start to get a clearer view of just how much maybe things are starting to crack. Just a little bit of dissent appearing on the FOMC that makes it difficult for the Fed chair to reflect a consensus that is not there when he goes into that news conference, because the difference between Chairman Powell and President Lagarde, you compare and contrast what we heard from President Lagarde yesterday and Chairman Powell on Wednesday. There was a lot more on the one hand this, on the other hand that, if buts and maybes from Chairman Powell. President Lagarde, no. Just bang, 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 straight down the middle.
She understood the political side of it perhaps more than Jay Powell did. I'll just editorialize on that view. That said, he also said that they're not going to cut rates, and their projections show that they're not going to cut rates. People just don't believe them, and at a certain point, John, you have to wonder, what data are they getting such confidence from that the Fed is looking past and saying, stop it?
Goldman right now down 8 or 9/10%. Crystal ball time, looking out to next year. Here's some calls for you. Bank of America, 4K, year-end 2023. Cantor Fitzgerald, year-end 2023, 4,100. Credit Suisse, 4,050. 4K, Goldman Sachs. 4K, HSBC. Jefferies, 4,200. JP Morgan, 4,200. Morgan Stanley, 3,900. RBC, 4,100. You get the picture here. There's a lot of people bunched around 4K. So be thankful that our next guest is saying something a little bit different. 4,575. It's Sam Stovall at CFRA. So Sam, walk me through why ultimately you're a lot more bullish than the bulk of the street going into 23.
Hey, Jonathan and Lisa. Well, I guess some could accuse me of being a Pollyanna. I like to say that when life gives me lemons, I try to make whiskey sours. But what I'm looking at is the expectation that we are likely to fall into a recession. I mean, I'm saying right now that like a deflating holiday lawn ornament, the Powell press conference and today's Goldman news have drained investor hopes of avoiding a recession. But I think it's going to be a mild recession. I do think the Fed will continue to raise rates through the first quarter. But then I'm reminded of history saying that on average, 8.5 months after the last rate hike, we see the Fed starting to cut rates. So if we do end up seeing this economy getting weaker than is expected now by the street, and also seeing what the Fed responds to, I think investors will be looking across the valley into the second half of 2023, and that's where we end up seeing an upward movement. And the real year-end target also depends on whether we simply retest the 3,500 low on October 12th, or we set an even lower low.
So what is your downside in the first half?
Downside, I'm thinking 3,500 for the S&P 500. That is the October 12th low. It is a Fibonacci retracement level of the prior bull market move. And also, I think that was an area of significant support. And so that is my first level.
So, Sam, if we get down to 3,500 and you're saying the recession is only short and shallow, why do you think the recovery in the equity market is as severe as the one that you're calling for in the second half? Where does that come from? What drives it?
Well, I'm a big believer in history. You know, history is a great guide. It's certainly not gospel. However, when you look to all of the bear markets since World War II that were accompanied by recession, we ended up coming back into a new bull market, meaning rising 20% in an average of only 3 months. And in 5 of those 9 times, we ended up in a new bull market after only 1 month. Also, what we found is that 12 months after, the market was higher by 47% on average, with a low water mark being 30%. So basically, it all depends on when that actual bottom takes place. And my feeling is that we are likely to then see this vacuum of valuations be taken advantage of.
Sam, when you talk about history and you talk about post-World War II, Have you ever gone back to 1918, right? I mean, it's a playbook that perhaps goes to another era of pandemics and then conflict as well, and World War I and everything that was going on then. Is that a better kind of measure of where we could be and the sort of difficulty getting out of some of the issues that are facing not only the market, but also just generally geopolitical peace?
No. And I say that because, like the valuing of crypto today, we didn't really have the required earnings information for individual investors to make decisions back prior to the 1930s. Also, we never had government-supplied economic data since the late 1940s. So really, you should be looking at data only since 1950 or so, but I go back to World War II simply because that's sort of a dividing line. So I would say the reason I don't go back to the 19-teens is because it really was more of a gambling situation because you did not have the free flow of financial or government economic data.
Is China reopening, Sam, a headwind or a tailwind to your call?
I think it's going to be a tailwind globally. Expectations at the beginning of 2022 were that we were going to see a 4.6% gain in global GDP. That estimate now is below 3%. And then when you look to 2023, it's even weaker. But if you look to China, that's really the only country that is expected to show an improvement in GDP in 2023. To a broader extent, the emerging markets are likely to show an improvement in GDP next year, whereas the advanced economies are predicted to show a slowdown. So I would think it's going to actually be a tailwind for the global economy.
It was so much easier when we used to talk about synchronized global growth. Do you remember that? Everything all at the same time. Now looking out to 23 is so different. Europe recession, US recession, China reopening, those two things colliding. Is inflation going to be sticky as growth rolls over? Bramo, that's going to be the call for 23.
Where's energy prices? Where are they going to be? What about policy? I mean, honestly, pick your issue, and it's going to be just a moment of confusion and historical reference points. But you wonder whether the consensus is, and you point to this, too cute just simply because how do you have a consensus with all these variables?
Claims at 211. I think there's people looking exclusively at the labour market and saying claims at 211. Goldman news aside, tech news to one side. Look at the labour market, look at the data. Where's the recession?
It's not just the numbers in terms of the unemployment claims. It's also the numbers with respect to wage gains. They are accelerating. They are not disinflating.
Hey, Sam, wonderful to catch up. Sam Stovall there of CFRA. Their call, 45.75, 12-month price target on the S&P 500. What did Greg Jensen say over at Bridgewater about this China reopening story? I think that's really interesting.
I thought this was fascinating.
Does he think it's a problem?
He thinks it's a big problem. He thinks it's going to be inflationary. He thinks that it's been a gift to the U.S. and Europe that China's been offline for a couple of years, not creating demand for base commodities. When they come back online, it will be a big inflationary push at a time when Europe is entering recession and the U.S. is slowing down. So a very controversial take on the same event. I mean, this is the reason why it's such a complicated moment. A China reopening, is that a good thing or a bad thing to your investment thesis?
So growth down, inflation sticky, terminal rate high for longer. Is that going to be the call? Get long energy, stay short tech? Is that what they're sticking with?
Yeah, that's what some people are saying. I mean, are you saying from my personal call?
No, I'm just wondering. I'm wondering what the thesis is around that call.
That seems to be the case, and that yields are going to be higher, and it's a new investment regime.
Okay. Well, in about 18, 19 minutes, we'll get the Fed's view on this. The core of the Fed, the chairman, the vice chair, and the head of the New York Fed. We're going to catch up with one of those, John Williams, the president of the New York Fed, sitting down with Bloomberg's Kathleen Hayes in about 18 minutes. Look out for that on TV and radio. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Another large-scale Russian attack on Ukraine's infrastructure. A barrage of missiles knocked out power across Ukraine today. The capital of Kyiv was one of the cities hit, and that attack comes a day after a top Ukrainian army commander warned that there's no doubt Russian forces will try to seize Kyiv as soon as next month. A Russian assault in the spring failed. In Beijing, a rapidly spreading COVID outbreak has turned the Chinese capital into a virtual ghost town. That underscores the cost of President Xi Jinping's sudden pivot away from COVID-0. Anecdotal evidence suggests entire families and offices in Beijing have become infected in the span of just days. That could be a preview of what the rest of China faces. American Nobel Prize winner Philip Dybvig faces a sexual harassment inquiry at Washington University in St. Louis. A former student is the accuser. Bloomberg has spoken to 7 former students who allege that Dybvig sexually harassed them. His lawyer says he never had any improper physical or verbal interactions. Dybvig won this year's Nobel Prize for economics. Goldman Sachs reportedly plans to cut as many as 4,000 jobs. That's according to the news outlet Semaphore, which says the cuts could amount to 8% of the firm's workforce. Goldman has been struggling to reach profitability targets. And private equity firm Advent International has agreed to buy satellite owner and weather forecaster Maxar for about $4 billion. Shares of Maxar more than doubled in pre-market trading. Including debt, the transaction is worth about $6.4 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Judge that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach.
That was near the start of the news conference. Later on, I think increasingly President Lagarde lost some patience. Through the Q&A, near the end. We're not pivoting, we're not wavering, we have more ground to cover, we have longer to go, we're in for the long game, just punch, 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 punch. You remember we talked about the hawkish greatest hits of Chairman Powell in the November news conference? It was kind of it from President Lagarde there yesterday at the ECB.
But there was one message, and one message in it alone,
without a doubt.
You are misinterpreting me every single time. I am being very clear. Do you think she rehearsed that?
In the mirror?
Yeah, there will be no pivot. Pivot.
Possibly. Well, the bond market's listening in Italy, unlike the Treasury market, which has not been listening to Chairman Powell. You mentioned a 2 years, so let's talk about the front end of the curve in Italy yesterday. That was a 39 basis point move. That's not normal. On a 2 year in Italy this morning, up 8 basis points. And when you think about things that aren't normal, just bring up the German 2 year on my screen and get you the last couple of days. Today, the German 2 year is up 7 basis points. The 2 year yesterday up 25, 26 basis points on a German 2 year yield. That's pretty impressive, that move.
It's shocking, considering where we've been and that we were negative for so long. It's also shocking to think that we're heading into a downturn and there will not be a fiscal response. that is capable in the same kind of way if you're borrowing at these kinds of levels. And that's why I think the Italian response to this, even behind closed doors,
they're furious,
is very interesting. And that's perhaps why you're seeing a bit of softness in the euro as well, because what does this mean in terms of the reaction function and sort of the offset to any kind of downturn?
More rate hikes and a bit of QT. Shahab Jalanoos joins us now, Global Head of FX Strategy at Credit Suisse. Shahab, what did you make of that from President Lagarde yesterday?
It certainly beat most people's expectations in terms of implied future rate hikes. Our own economists at Credit Suisse now look for 3.5% as the terminal rate for the ECB, which is pretty high, higher than I would have expected a year ago.
You think they're going to be there long?
Well, that's the thing. If you now start looking at futures expectations in the interest rate curve, you're starting to see the inversion get much bigger. For example, if you look at September 23 futures against September 24 futures in the Euribor strip, we're now looking at a 50 basis point inversion there. That was 37 basis points before this move. So the market, it can believe in the idea of the terminal rate being that high, I think, but it's not going to believe as much in the idea that it can stay that high. And I think that's going to be a weak link for the euro going forward.
Well, and so in other words, given the fact that the ECB seems determined to move forward with this, is this going to be a parity type of situation for the euro again, or do you think that it will really break in terms of what the resolve will be from the ECB?
No, I think it's probably more of a barrier to consistent gains for the euro rather than an instant reason for it to go back to parity. So if you look at the dollar, for example, at the end of September, we had the same 50 basis point inversion between September 23, September 24, SOFR futures. Now that's 150 basis points. So the market, again, was pushing down 2024 rates quite aggressively for 3 months, and the dollar fell throughout that period of time. I think we're at a much earlier stage in this process for the euro. I think the euro can go a bit higher still, but I'd be keeping a very close eye on exactly that same spread in the euro as well, because as that gets more inverted, that takes away the steam, I guess, the energy behind the euro's ability to rise.
This is what I'm struggling with, John. I mean, if you end up with a weaker euro on the heels of a hawkish proclamation from the ECB,
I know.
This increases the inflation risks in the euro region. How do they counter that?
It was the problem earlier this year. We talked about it a few times. So, Shahab, I guess the big call for an FX strategist, regime shift. They change, they adapt, they evolve. Sometimes it's all about rates differentials. Other times it's just about risk sentiment more broadly in the market, maybe even the economy. What do you think is the most dominant factor right now, and perhaps what is going to be the dominant factor in 23 for this FX market?
So certainly rate differentials have been an important factor. That's why euro dollar is back at 106, when we started below parity, this quarter. So I do think that that's a significant factor. But there's also the terms of trade story as well. If you remember, euro was not weak only because of rate differentials. It was weak early in the year, largely because of balance of payments shifts linked to very high energy prices. Europe's got lucky. We had a very warm winter thus far, and also the energy supply problem has been less of an issue than people thought. So that's another thing to think about. I think you've had both of those factors play into euro's recovery.
Can you just sit on the structural story for a moment? For a long, long time, there were complaints in Europe by the Europeans that the euro was too strong.
Yeah.
Draghi ultimately introduced negative rates in the summer of 2014 to fight against that and pushed back pretty hard, and we had some success. The Germans always got the blame for it, for running a surplus, a current account surplus across the Eurozone. Even when we had difficult times on the periphery, that was something that persisted, and it meant we ended up with persistent euro strength. Are you seeing a structural shift away from what was dominant maybe 10 years ago? And what does it mean for this currency?
There's definitely been a structural shift because now you have the euro area as a whole with a current account deficit. And the big collapse in German exports is a large part of that, as well as the increase in energy imports costs that's come through as well. Unless you think that's going to change quickly and go back to how things were, we have to assume there's been a structural shift that's going to persist. And the net result of that is a weaker euro than would have otherwise been the case. It also requires the euro to be supported more than it would have been in the past by higher interest rates. But I think at least from that perspective, the ECB is delivering, as we're seeing. So that's, I think, one comforting factor if you're a euro bull at this point.
That's the European side of things. From the U.S. perspective, we're less than 10 minutes away from hearing from New York Fed President John Williams after that speech that we heard from Jay Powell after the press conference. What would a truly hawkish Fed, or perhaps should I say the market believing what the Fed is saying, due to this dynamic? Would that actually give strength to the dollar, or weakness just simply because it would indicate perhaps a weaker economy going forward?
I think at the moment, the burden of proof has shifted quite significantly as far as what the data is showing. Previously, we were consistently beating to the upside on inflation outcomes, and the market was chasing that reality. Now we've had 2 months in a row of downside misses. So the market doesn't really give the Fed all that much credibility in its predictive power because of what we've seen, in the last couple of years.
Particularly the last 12 months.
Right, exactly. So it makes very little difference, I think, at this point, what the Fed says to the market's reaction function. As we can see, if the market sees soft data, the market's going to run with that. And that's the result of what we've seen in the past in terms of Fed's communication strategies and what's actually turned out to be the case in data. And you're seeing that in the inversion of the curve that I mentioned. So the only way that's going to change, in my view, is if the data change. If we get a surprise upside print, for example, in inflation, or if the labor market simply doesn't deteriorate as quickly as people think. It's going to take a while before we see those numbers. So I think anything the Fed says right now is going to be not that impactful on the market.
A year ago, even after they dropped transitory, they were looking for 90 basis points worth of hiking in 22. We got 400 plus. The ECB president 12 months ago was basically indicating we might not get a rate hike through the whole of 2022. Look at where we are now. Even at the last meeting, the one before this one, it wasn't in the base case that we'd get a recession in the Eurozone. A couple of months later, here we are talking about a recession in the Eurozone in Q4, Q1 from Europe. So they've been dead wrong through all of this. And I think that's where the doubt comes from. What's interesting for me this week is why we believed the ECB a little bit more than we believed the Federal Reserve. So the credibility of their forecast is shot over the last couple of years, sure, completely agree, but for both central banks. But why were we paying more attention to the rate story that Lagarde was selling and not the rate story that Powell was selling? Is it the difference in the data? Perhaps it is, and I think that's what Shahab is alluding to.
It's also this idea that they have not taken the decline in natural gas prices, the fact that there has been a more controlled situation there as any kind of reprieve or breathing room, and that they didn't give any credence to that whatsoever. But to your point, it's a good question because both banks struggle with credibility.
Shahab Jalanusa, Credit Suisse. Shahab, awesome to have you in the studio. Thank you, buddy. As always, want to go back to that Goldman story just briefly. This comes from a news organization in the United States called Semaphore. Goldman Sachs set to cut as many as 4,000 workers. The stock in the pre-market looks a little something like this, down about 0.9%. But that number much, much bigger, a multiple bigger of what we expected a little bit earlier this week, Bramo, if it is indeed confirmed.
And what we're seeing from our own reporting seems to be a person familiar with the matter telling Bloomberg this being the case as well. So more kind of hints that this could be very much the case.
Up next on the program, don't miss this. The New York Fed President, John Williams, sitting down with Bloomberg's Kathleen Hayes, live on Bloomberg TV and radio. Later on this afternoon, Mike McKee and Loretta Mester. We'll pick this all up in the next hour, counting it down to the opening bell with Jim Bianco, Rob Waldner, and Judy Bill. This is Bloomberg.
talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The secret of success of any company is to grow. And I think that we, WPP, and our industry more broadly, can be really at the heart of a client's growth. You know, how do they succeed with consumers? How do they reach them in new areas? How do they innovate? How do they create new brands?
About an hour to go before the opening bell. We do see the softness from yesterday continuing a bit ongoing. We're also getting more insight with Bloomberg matching the reporting from Semaphore about perhaps 4,000 job cuts over at Goldman Sachs as they trim their workforce by a potential 8% in the wake of 2 years of not really cutting staff and weakness in certain units. Right now across the board, you're seeing the S&P down about 1%, euro a bit of softness, a bit of dollar strength, and 10-year yields a bit higher, but not anything like what we saw over in the European markets, 3.5% basically, 351 on the 10-year. Right now, as we look at Goldman Sachs and this question of all of the job cuts, there is a question of whether this is a broader story of layoffs and a weakening labor market, or if this is idiosyncratic with certain markets that have blown up in terms of the number of staff over the past few years. Right now, I am so pleased to say we can head over to the New York Fed. Bloomberg's Kathleen Hayes there with one of the leadership members of the Federal Reserve, New York Fed President John Williams, to answer some of those questions. Kathleen.
Lisa, thank you. President Williams, thank you for joining us this morning on Bloomberg Television. So happy to have you. Here we are in the New York Fed Museum in a year when the Fed has been making a lot of history. So let's start with the meeting this week and what came out of it, because we got the move up in to the restrictive rate that was even more restrictive than people thought. And, inflation has stayed high. It's proved hard to get down, probably harder than you thought it would just a few months ago. With these dots, with this position now, do you think you finally caught up to where you need to be?
Well, I think we're well on our way there. And I think when you look at the central tendency of the dots, my colleagues expect the Fed funds rate to get to, say, 5 to 5.5% next year. I think that gets us into that hopefully sufficiently restrictive stance of policy that will bring inflation back to 2%. So I am getting increasingly confident that we're getting closer to that point, but obviously we have to watch the data. The inflation and other data have surprised us, and we need to be on the lookout for that. But I do feel we're getting to a better place.
Now, just about 2 weeks ago, you said that the Fed funds rate has to get above the inflation rate to bring down inflation. How far above inflation does it have to get?
Well, that's the question, right? In we talk about this as in terms of sufficiently restrictive to bring inflation back to 2%. So to me, it's really about getting it high enough, and of course keeping it high for enough time to really see clear signs inflation is moving back down on the way to 2%. My view is you have to think about real interest rates, as you said. If you look at, again, the median dots, if you will, in the economic projections that we just put out, you see the real Fed funds rate, say the Fed funds rate minus the core PC inflation, around 1.5%. I think that's a reasonable view of restrictive. Again, whether it's sufficiently restrictive, we'll have to watch the data and see, but I think that's, to me, basically where I'm thinking right now.
Now, there's many top economists, former Fed officials even, who are saying it's looking more and more like you are going to have to go higher, even than where you are now. Maybe something like 6%, maybe something heading towards 7%. Can you see that happening? And what circumstances, what would be happening for that you have to go ahead like that?
Well, that's definitely not my baseline, as I just indicated. I don't think we'll need to go real interest rates that high. But of course, things could happen differently than we expect, and we'd have to, especially around inflation, but also how strong is the economy, even with higher interest rates? Do we still have these imbalances between supply and demand? Right now, I mean, PCE inflation is 6% over the last 12 months, and we have clear signs that demand exceeds supply in our economy and our labor market. So to me, the question of how high we have to get to is really going to depend on what we see in inflation and the supply and demand imbalance. Again, my base case is we don't have to get that high. I think we have some favorable developments underway, things that we've been talking about for a long time. Supply chains definitely are getting better around the world. We're seeing that in a lot of different data. And we're also seeing, some of the goods prices and import prices come down, a reversal of some of those pandemic era things that pushed up inflation. So we've got a few factors I think are going to bring inflation down to 3 to 3.5% next year. But then the real issue is how do we get it all the way to 2?
Of course it is, but right there, though, is the message from Wednesday that, and this ties in with, if you might have to go higher, is the message that if it's not coming down as we expect, then we are clearly open to going higher, taking the next step?
Well, we're going to have to do what's necessary, again, sufficiently restrictive to bring inflation down to 2%, and it could be higher than what we've written down, and we have had to increase our interest rate projections as the data have come in. The inflation has been stubbornly high, as many people have said, and we've seen the economy remain very resilient to higher interest rates. Remember, the unemployment rate is 3.7%. Some signs of slowing demand for labor, but still a very, very strong imbalance between supply and demand right now.
There were two surprisingly good CPI reports going into this meeting, and so a lot of people thought, well, good news for the Fed. Maybe they're not going to be quite as aggressive. But at the same time, what happened? 2023 inflation forecast, boom, goes up. How did this happen? What's guiding your view on inflation? Again, two good surprises on CPI, and yet the PCE core and PCE overall still expected to rise.
Right, and again, relative to, say, our earlier projections in September, I think that you really have to think about what's happening in the inflation data. So we are seeing good news. I like good news on inflation reports. A lot of that's in the goods areas and some of the areas we've been long expecting those inflation rates to come down. So that wasn't so, that's something that we've been expecting to see as part of the baseline forecast. Where inflation is still high is in these core services areas, the areas that, are probably going to be more persistent and really reflect the imbalance between supply and demand in the labor market and in our overall economy. So sure, we are seeing some good signs on goods and some other categories. I'm also seeing some good signs in the rents for new leases of apartments and houses. So, that inflation should eventually start coming down later in the latter part of next year. But again, in these other core services, that inflation rate is still high, and that really gets to how strong the labor market is. So sure, some good news, but the underlying issue of core services inflation is still very much there.
Well, your forecast for unemployment next year is a big jump, right? You see it much weaker, up to almost full percentage point from what you're looking at in September, 4.6%. You're looking for GDP to be much weaker than you thought 3 months ago, down to 0.5%. So is this the kind of forecast that is consistent with a soft landing? Is it consistent with something maybe not quite that good?
Well, I think it's an economy that's continuing to grow. As you pointed out, the median dot is around 0.5% growth for this year and for next year. So as an economy that's growing, it's an economy where the unemployment rate is rising somewhat. As you mentioned, the median will be at 4.6% at the end of next year. So I don't see this as a recession. We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
The retail sales were weak across the board pretty much. Is this a canary in the coal mine for where the economy is heading and a part of the economy you want to get final demand down?
Right.
Is this maybe an early sign that you're succeeding?
Well, we have to look at all of the data on that. And obviously where we're seeing the signs of the economy slowing is in the housing sector and now in manufacturing. Consumer spending has been kind of jumping around a bit month to month, quarter to quarter. It's actually been more, up until this latest data, more resilient perhaps than I was expecting. So we just have to, go through all that data and really see kind of the underlying strength in the economy. That data doesn't change my basic view that we're going to have an economy growing modestly over the next year.
You know, you're talking about the services X housing, right? Core services X housing seems like it's the key indicator now. We have to see that coming down for the Fed to be convinced that inflation's moving in the right direction.
Well, I think that it is most closely related in many ways to the state of the labor market and domestic price pressures. Some of these other categories, which of course are part of the inflation index, we don't ignore any of them, but they really are about the special factors, right. Car prices that skyrocketed, sure. Transportation costs and things like that. And then I think the housing market, we're already seeing some good indicators eventually of that coming down. So this is the area that's not coming down, and we definitely needed to see it coming down to get to that 2% inflation goal.
So a lot of focus on labor and wages in that part of it, right? That's what's important. That's what Chair Powell pointed out this week. So do you think that there are signs of a wage price spiral right now? Is that one of your concerns? Again, and when you look at CPI is coming down, that's good news, but boy, oh boy, the trend is still too much up for us.
Yeah, so I don't see any signs of a wage price spiral of the kind that we saw in the 70s. A couple data points I'd point to. One is inflation expectations have been coming down. They've been really well anchored for longer run expectations, but we've also seen in our New York Fed survey and in the Michigan survey, shorter term inflation expectations coming down. So I think that we're not seeing that kind of dynamic kick in of people expecting higher inflation, demanding higher wage increases because of that. The other is, I really see wages as kind of the barometer, one of the barometers of the strength of the labor market about demand and supply. Right. I think wage growth has been very high because labor demand has been really strong relative to available supply. As labor demand and supply get better in better balance, I think the wage gains will be more consistent with longer term trends and our 2%.
What do you make of the Southwest Airlines contract that was just signed? They're going to get a 24% increase in wages over the next, 4 years, excuse me. Is that a concern?
Well, we're seeing a lot of adjustment in wages for around the country. I'm not going to point to any specific one. I mean, again, wage increases right now, given where inflation has been, given where the labor market is, are still quite high. And so we're watching those indicators. Okay. To me, it's really about tracking how the economy does over the next year, labor demand and supply and wages.
I want to focus on financial conditions. Chair Powell noting that the markets and the Fed seem to be working at cross purposes a lot of the time lately. Are you concerned about this push-pull between the Fed and where it's trying to lead and where the markets want to go?
Well, I think we need to be, and we are being clear on what we're going to achieve, and how we're going to achieve it. I think that the economic projections and the dot plot we put out provide a nice roadmap of how we're seeing the economy and monetary policy over the next couple of years. And obviously, financial conditions depend on a lot of other things than just monetary policy. So I always look at a broad set of financial conditions, understand how that feeds into our outlook. Right now, I know that some market participants clearly are more optimistic about inflation coming down. I look at the real interest rates implied by that. I think pretty much everyone understands that real interest rates need to get restricted and stay there for a while.
Is that an issue for the Fed, though, when you're trying to move policy in a certain direction, right? You want to tighten, and if the markets rally and then financial conditions soften, for whatever interpretation the markets are taking, is that an issue? Does that make the job harder?
It doesn't make the job harder, but it's just another one of those factors, like what's happening in the global economy, a lot of things that have to feed into our view of where the economy is going and then what we need to do. Clearly, to the extent that financial conditions have tightened quite a bit over the past year, consistent with our moving towards a restrictive stance of policy, that's an important part of the transmission of monetary policy of the economy.
In keeping with that, I want to ask you one last question, because we're hearing this a lot, that the Fed let inflation get out of control for whatever reason, and that this may have eroded the credibility of the Fed with the markets. How do you respond to that?
Well, we're absolutely committed to getting inflation back to our 2% goal, and we're acting in that way. I think we're communicating in that way. So I don't think we've lost the credibility, of course, at all. I do think that, we are completely united in our focus on getting inflation back to 2%. We've taken extraordinarily strong policy actions over the past year, and as we've shown, we're going to continue to take the actions that are needed to get inflation back to 2%. Price stability is absolutely essential for a strong economy in the long run. We need to get that done, and we will.
All right. Well, 2023, here it comes. President John Williams, thank you so much for joining us today.
Well, thank you.
Okay, Lisa, back to you.
Great work. Kathleen Hayes with John Williams of the New York Federal Reserve. Thank you. Not seeing signs of a 1970s type of wage price spiral, talking about modest growth coming down, but not necessarily a recession. I want to just give you more details. Bloomberg now confirming the reports earlier from Semaphore about Goldman Sachs potentially cutting as many as 4,000 jobs. According to the story, top managers have been asked to identify potential cost reduction targets. No final job cut number has been identified, but they are all continuing to deliberate on this after a period of tremendous growth. Just to give you some perspective, the workforce had grown by 34% since the end of 2018, surpassing 49,000 in this year's third quarter. Coming up, we'll have more of a sense of the potential ramifications from that. The S&P futures down about 1% ahead of the open. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
This is a simple case of where did the money go?
And the technology.
If people wish to invest in it, they must be prepared to lose their money.
I am still very positive on real utility into this space.
Bloomberg Crypto, Tuesdays.
What you see in these periods of higher inflation when central banks ease more slowly into the recession is they last longer and the drawdowns in assets are longer. So we'd expect kind of double the normal length of a recession because the Fed's not going to be at your back for a long time, and that's a big deal.
That was Greg Jensen, Bridgewater Associates Co-Chief Investment Officer, after talking about how a reopening of China is not necessarily a tailwind for risk assets. It could potentially be a headwind, particularly for the U.S. and Europe, if you do get a situation where it boosts inflation at a time when Europe is heading into some sort of downturn. Right now in markets, we are seeing futures lower ahead of the open, adding to the losses of yesterday. S&P futures lower by about 1%, and Goldman Sachs adding to that with also a 1% decline after reports of potentially 4,000 job cuts. Euro's actually gained a touch versus the dollar, basically flat, 106.29. 10-year yields up just a bit, not anywhere close to the yield move that we've seen in European markets after what we heard from Christine Lagarde. And oil, a little bit lower as people get concerned perhaps about the prospect of recessionary conditions, 2.5% decline on the NYMEX, $74.21. We've been talking all morning about Goldman Sachs and the potential layoffs within their ranks as they start to reshape ahead of what's to come. Their shares are down almost 2% in pre-market trading. There's also a question about how the banking industry is reshaping ahead of the potential downturn, where people are living, where they are moving to. And Pretium was sort of interesting to me because it was a hedge fund firm that was founded by a Goldman Sachs partner that actually just opened a Florida office. Josh Pristaw is joining us now. He's co-head of real estate at Pretium, which is not what he wanted to talk about. You wanted to talk about a whole host of other things having to do with the real estate market, as do I. But I want to start here because of the Goldman Sachs news. Do you see a wholesale shift in where people are looking to live, where people are looking to spend money, and allocating your capital accordingly.
Thanks, Lisa. Pleasure to be here. As you mentioned, I'm Josh Prista, head of real estate for Pretium. Pretium's a $50 billion alternative asset management firm. We manage real estate investments in approximately 100,000 single-family rental homes across 33 markets in the U.S., valued at around $33 billion. So, great question. Our investments over the last 10 years have really followed a general theme of cheaper and warmer. So the migration trends are from generally the coastal cities to places in the Southeast and Southwest. So I think we'll continue to invest in those locations. But to your point about opening an office in Miami, you know, our job is to find great investments for our investors, but also attract the best human capital. So we will, as we become more flexible and look to find the best talent, that could be anywhere. So.
We are talking about the potential for layoffs, the potential for some sort of downturn, and people are very concerned about the housing market more broadly due to how high mortgage rates have gone. How has the pace of the capital that you've deployed in buying up some of these single-family homes changed this year versus the same time last year?
Sure. It's definitely slower as interest rates have gone up. But the interesting thing about what the Fed's doing with increasing interest rates as part of a strategy of, I would say, deliberate demand destruction in the single-family for-sale market to tame inflation is interestingly stimulating demand for rent because, as you pointed out, it's more difficult for people to buy. So our view is over the long term, rents are going to grow faster than home prices, in part because of that.
Well, but we've seen recent anecdotal data showing potentially even downturns in rents and the valuations there, particularly in some of the cheaper and warmer places that you're talking about. Do you think that those anecdotes are inaccurate and don't really jive with what you're seeing on the ground?
So I think people during COVID, data I think was distorted or smoothed out. So historically, pre-COVID, pre this surge in demand for all kinds of goods and rental housing or even homes for purchase, there was always an element of seasonality. So rents and home prices usually go down in the back half of the year. Our data shows over 10 years, almost all of the rent growth is in the first half of the year. And that's because most people either buy a home or rent a home in advance of the school year. Now, that being said, we are seeing a deceleration compared to the very torrid rent growth and home price appreciation earlier in the year. But I do want to point out, because you referenced job losses, is that job losses and the fear of recession, which is in the media and the news every day, is probably having a dampening effect on household formation. But when we look at the long-term fundamentals, because we're not trading these homes, we're investing in them long-term, those fundamentals look really great. As the millennials move into the peak household formation period, they overwhelmingly want a single-family home.
As you raise capital, you think about when to deploy it. You say that you still are deploying, although perhaps not at the same pace that you were last year. I do wonder if you're expecting some sort of dislocation that will offer a better price entry point.
Sure. So actually, I think it's a really incredible time because for single-family homes, it's perhaps the only institutional real estate asset class that has been repriced to today's reality of demand and interest rates. And that's because there's a difference between long-term owners and short-term owners. We're relatively constructive on home prices. We think they will continue to fall a little bit next year, maybe 4 or 5%. But the housing market's very stable because essentially 83 million Americans have a mortgage that is at a 3.25% interest rate. So most Americans can't afford to sell their house and buy a smaller home if they're going to swap a 3% mortgage for a 7%, let alone a bigger, more expensive house.
Another way of asking this is some of the other big single-family homeowners. I'm thinking of Blackstone. I'm thinking of a whole bunch of others that have gotten into this area. Are they selling? Are they paring back? Are they starting to look around for potential interested buyers?
Sure. We buy homes. We bought 58,000 that way in the last 10 years. We buy homes from other portfolio operators, owners, and then we buy homes from home builders. We see perhaps the best opportunity today is to buy homes from home builders because with mortgages at 7%, they're having a hard time selling that inventory. So it's a fantastic opportunity to partner with home builders to basically bring new high-quality homes to American households and help solve the affordability problem that they're seeing.
What regions are you looking at in particular?
So we're generally in the Southeast and Southwest. As I mentioned, it's, you know, sort of cheaper and warmer. So think Phoenix, Las Vegas, Orlando, Tampa, Nashville.
Although it's gotten less cheap, right? And especially as more people have gone in. And there is a political question, especially as the Fed is trying to jawbone down inflation and they talk about, the rents are too damn high and all that. So how much are you concerned? How do you weigh that kind of calculus when figuring out how much you can raise rents and what's an appropriate level?
Sure. Well, we have tended to be very mindful of that and sort of self-impose rental caps. At a time, we're very focused on affordability, and our view is we believe in housing choice, and so we think that residents should be able to choose the neighborhood they want and make the determination: do they want to buy or do they want to rent? And part of what we're focused on, we just announced a partnership with a company called Isuzu, which essentially builds positive credit scores for people who pay their rent. I wasn't aware that 40 million Americans are essentially credit invisible. And so we are essentially helping them while they are residents with us when they pay their rent to build their credit score. So to the extent they want to buy a home, we're helping them on that path.
Is it taking longer to sign up people for leases at this point? Are people pushing back? Are you feeling sort of the pain that some people talk about when it comes to inflation, how much it's crimping people's buying power?
To a certain extent. Again, some of this is seasonal, so people forget that this time of year it usually takes a little longer and rents go down a little. But when we look at sort of the top of funnel demand, so data and technology really powers what we do. We have essentially a 2,500 person real estate operation that is committed to servicing residents and giving them a great institutional experience. The top of funnel, which is what comes in, people that are interested in looking at our homes at the prices that we're offering them, is up over last year. So we don't see a decrease in demand.
Just looking out, you said that you see a 4 to 5% decline in home prices maybe. Are there certain regions that you see a much bigger price decline than that?
I mean, what you've tended to see more in the more tech-focused sort of coastal regions like San Francisco, West Coast. We're not investing there, so that's the national number. Where we're investing, we expect that number to maybe be even lower.
Really? Even though there's been such price appreciation going forward?
There's a lot of demand. You look at where the migratory trends are, and it's cheaper and warmer, but we also like to follow the U-Hauls. So that's where people are moving. Companies are moving there. People are moving there. There's demand.
Follow the U-Hauls. I love that. Josh Pristow, co-head of real estate at Pretium. Thank you so much for being with us.
Thanks for having me.
Really interesting, especially as people talk about whether we start to see some disinflation from rents. A lot of people point to the fact that rents typically do not go down over time. Josh Pristow sort of accentuating that. Right now, ahead of the open, we are about a half an hour, 35 minutes away, and we do see those losses maintained, perhaps people resetting after really reading through what Fed Chair Jay Powell said, down 1%. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from New York City this morning. Good morning, good morning. The losses continue. The S&P down about 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Pivot. What pivot? Fed Chair Jay Powell says there's more to come. Governor Bailey is hiking into recession, and President Lagarde is going full hawk.
Wavering. We have more ground to cover. We have longer to go. We're in for the long game.
Joining us now is Invesco's Rob Waldner, Jim Bianco of Bianco Research. Jim, President Lagarde, we're not pivoting, we're not wavering, we have more ground to cover, we have longer to go. We're in it for the long game. What do you make of the central bank communication this week, Jim?
It was hawkish. There's no doubt about it that their focus is on inflation. And I think if you were to, define that a little bit further, yes, inflation has peaked. Yes, we all know it's coming down. And it's not really what's important. What's important is it going to 2% or is it going to 4%? And it seems like central banks are going to stay with their foot on the brake until they get solid evidence that it's going to go to 2%. And that's not going to happen anytime soon. So the full hawk, as you pointed out, is going to stay, and it's not going to go away, at least in the near term.
Rob, what's your take on this?
I thought it was extraordinary, John. I mean, we know growth is slowing. We've been getting good news on inflation. The yield curves in the U.S. and Europe are very inverted as they get, essentially, telling us that the Fed has max credibility, ECB has a ton of credibility, and they're going to push it when they're ahead. I don't really get why they felt like they needed to be quite so hawkish.
So, Rob, it raises the question, why did President Lagarde seem to gain more traction with this market yesterday and this morning, by the way, than Chairman Powell did on Wednesday?
Well, probably because the Fed is further along than the ECB. She was also very, very clear. I mean, we're not pivoting. We're not pivoting. So I think those are probably some of the driving factors there. And I think that the U.S. market has had a while to contemplate where the Fed's been going. We've got much better inflation data in the U.S. than we have gotten in Europe recently. And so the U.S. market just doesn't believe that the Fed is going to be able to deliver.
What's going on with that, Jim? President Lagarde shakes things up in a massive way. And Chairman Powell, there's so much doubt, skepticism. Does one have more credibility than the other when it comes to projections?
I don't know if one has more credibility than the other one, but right now I agree with Rob. I think that, the Fed has been at this game of being aggressive and hiking rates a lot longer than, as I like to call her, Madame Lagarde has been. She's only now just catching up to it. And that's why I think that when she comes out and says we're not going to pivot, we're going to continue to stay the course, it has more weight. If the ECB had raised rates 400 basis points already like the Fed had, you might have gotten a different reaction out of the market. But the market is looking at a big catch-up now by the ECB to catch up with the Fed.
Well, a massive catch-up in this market as well. Yesterday, on an Italian two-year, front end of the curve, two-year up by almost 40 basis points. Add some more weight into that yield this morning, up another 10 basis points on an Italian two-year to 3.15%. This is what Michael Hartnett over at Bank of America has got to say on this, gents, and I'd love your view on it. He says central banks are tightening into a mid-23 hard landing. The Fed has delivered 400 basis points of hikes in 9 months. There's another 50 to 75 expected in the next 5 to 6 months. The ECB's gone 250 in just 6 months, and we're looking for another 125 in the next 9 months. He said quicker labor markets, the quicker they break, the quicker they enter this bear market. Jim, do you share that view?
I do share the view, though, especially the last part of the view, that it's about the labor market. And that if we were to get the labor markets to break, that will change not only Fed policy, but all central bank policy. But labor markets have not broken. There's very little evidence right now, other than maybe some tech firms have laid off a lot of people, and you can throw Goldman Sachs today into the hopper. But that's not going to be enough to move the needle. We still see strong payroll growth. We still see low initial claims. We still see a great number of people looking for jobs versus the unemployed, that Powell's favorite metric of 1.7 open jobs for every unemployed person. That's what the Fed's focused on, and they all sum that all up, and we still see wage growth at 5%. So, yeah, if any of that stuff changes, that'll change policy, but it's not. And that's why I think that the central banks just continue to plow ahead.
You mentioned Goldman, the stock's down by 1.7%. Goldman considering as many as 4,000 job cuts. That could be 8% of the workforce. Bloomberg reporting that top managers have already been asked to identify potential cost reduction targets. Shonali Basak racing into the studio for us. Shonali, what's the latest?
We heard just a week ago from David Solomon saying that pruning would probably be likely here at the bank, and now you're seeing what that number could look like. 8% of the bank's workforce. Remember, the headcount is really swollen here, John, in recent years. You've seen acquisitions, you've seen hiring, you've seen growth in new businesses, and remember, they're preparing now for a tougher time ahead. Take a look at that headcount rise just in the years since David Solomon took over since 2018. I will say what's interesting, this is coming after the highest returns on equity you've seen since 2007 last year. Remember, other parts of the bank outside of that consumer business, outside of that markets unit, are very profitable. They've been minting money in trading. They've been minting money in investment banking, even in a hard year. And the question then becomes for Goldman, can you take from Peter to pay Paul? They have to spread the love across all the businesses as they look at their profitability targets. Remember, Goldman Sachs next year in February is going to have an investor update, and this is preparing ahead of that. These cuts are not ones we are seeing yet, but again, we will know in the coming weeks and months where these cuts come from, how deep they go. Will they go deeper than this initial 8% that is being considered now, and where they come from? I love this chart really quickly here too, John. If you take a look, the salary and benefits as a percent of sales here, Goldman has tended, it's that blue line over there, has tended to be very, 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 very efficient relative to peers. And so when you see them lead the market here in the job cut story, the reality here is it could be a harbinger of things to come. It tends to be a sign for other banks to show that maybe they have wiggle room here on the expense line.
Shonali, thank you. Wonderful work, as always, and great reporting from the team here at Bloomberg. We'll catch up with Sri Natarajan at about 24 minutes on the same story to get another update for you. Jim Bianco, which one is it? There's a word that I get scared of. It's idiosyncratic. Things happen in tech. I'm told it's idiosyncratic. They start to happen in banking and financials. I'm told it's idiosyncratic. Which one is it, Jim? Is there something going on here in an industry that's specific to these names, or something happening in the broader economy?
Well, the signs are not quite there when you talk about the labor market in the broader economy. The signs are only in tech with the layoffs and in the interest rate sensitive markets of like real estate. That's where you're starting to see a lot of the weakness. But in the rest of the broad economy, you're not seeing it yet. And the reason I bring that up is, again, I, like a lot of people, do suspect that you will see a slowdown going into 2023, but you need to see that. The chairman has been very clear, show me the slowdown first, and then I'll consider changing policy. And the longer we go without seeing that, and as long as it stays idiosyncratic, I don't think you're going to see the Fed pivot off of any of this kind of move or even slow down with its belief that they've got to go above 5% on the terminal rate.
Well, let's recap the data this week. We can look at industrial production, Rob Waldner. We can go over what's happened with retail sales, and then we can look at jobless claims. Factory production declined for the first time since June. We had retail sales yesterday dropping the most in 11 months. And then we had jobless claims come in just above 200K. Begs the question, really, doesn't it, Rob? What should I be focused on? Because the labour market, just looking at the headline data, says things are okay. Then there's cracks elsewhere.
Absolutely. So we seem to have gotten to this point where we're hyper-focused on the labor market. The Fed has told us that's what they're looking at. But I'm not sure that really makes that as much sense as looking at the overall economy. We're assuming here that the Phillips curve is suddenly going to start to work, and that the whole basis of the idea that to get inflation under control, you have to raise the unemployment rate is really around the Phillips curve, and that hasn't worked for a couple of decades here. So I think we should be paying more attention to the economy itself, Jonathan, and not the labor market data per se, to understand how inflation is going to evolve.
Well, let's talk about the economy, and let's talk about another consensus view for 2023. We've all heard the following words: short, shallow. This from the ECB in the statement yesterday. It said, according to the latest Eurosystem staff projections, a recession would be relatively short-lived and shallow. I caught up with Alessio De Longis yesterday of Invesco, and I asked him whether we should question that consensus view into 23. Take a listen to what he had to say.
The economy is a lot more resilient than we think it is. The mild, shallow recession is a hypothesis that is credible, but probably a little bit longer in duration. What if restrictive policy for a lot longer means simply growth below trend for a lot longer, or negative growth for a lot longer, but without that much volatility? That's, to me, an open question.
Let's explore that question right now. Jim Bianco, we're essentially assessing depth and duration. Depth, the shallow piece of this, I'm told repeatedly, resilient economy doesn't have the excess it's built up in previous recessions, doesn't exist, it's going to be shallow. Duration is the point I want to sit on just for a moment with you, Jim. If these central banks are determined to stay high for longer and take out demand in this economy, shouldn't we be questioning that half of that theme for 23, which is short, shallow? Where does the short piece of it come from?
I agree. We should be questioning it. And as far as the short piece, Jonathan, let's back up. Does anybody remember that the first and second quarter this year were negative GDP, and the third quarter growth barely recovered with what you saw in the decline in the first and second quarter? So if the economy turns down in 23, you could argue it's well over a year since the economy has peaked. That's not short at all. As far as the shallow part goes, if you look at history, it's very hard to get a soft landing. A soft landing is what you usually call the economy right before it crashes. And because when it starts down, it usually continues to go lower. You know, one good example is what's called the Somme rule, named after Claudius Somme, former Fed economist, that when the unemployment rate goes up 0.5%, and that usually happens in a recession, it usually goes up another 2% after that, or maybe even 2.5% after that. So I know that people like to think that the unemployment rate is going to go to 4.5. Well, if it goes to 4.5, it's more likely to go to 6 than it is to peak at 4.5. And that really calls into the question the idea that it would be shallow.
Let's build on that, Rob. We're assessing the potential duration and depth of a recession in our future. Maybe it's just around the corner, perhaps it's further out. Rob, do you push back against any of it?
So I think we need to break this down. And the length is going to be determined by the Fed, the depth by imbalances in the economy. So let's break that down. The central banks are getting very, very hawkish. So I think that we're going to have a big headwind to growth here for quite a while, because they're telling us they're not going to cut rates. So if that's the case, this could be a long period of subpar growth. In terms of depth, I think that's about imbalances in the economy. And we just don't see them, Jonathan. We don't see where there's a buildup of leverage in the economy, in the real economy, that could impact the financial system or that needs to be worked through out of the households. In general, you know, without those big imbalances, we don't think the depth we get a deep period. So it would be, you know, a longer period than we might expect, a subpar growth, but not a deep, sharp recession.
So does that leave you bullish or bearish on fixed income and Treasury specifically? I'll share a quote with you from SocGen Sabattara Japa. I'd love your response to it. Powell is stuck to his script of higher for longer after delivering a 50 basis point hike. She went on to say a hawkish shift in the dot plot failed to nudge yields higher, but ultimately they expect a modest rise in yields in the first quarter as central banks deliver more hikes. Now let's pick the 10-year. Let's pick one maturity across the curve and go with the 10-year, Rob. Your theme for next year, is it bullish or bearish, this bond market?
So my theme for next year is very bullish, this bond market, because we re-rated the public fixed income markets, treasuries, investment grade, much higher. You can get good income now in the fixed income market. So for all of 2023, unmitigatedly bullish for fixed income. In the shorter term, though, we have now the most inverted curve that we generally tend to get between 2s, 10s. And so if you want to talk about the 10-year note, as the Fed continues to ratchet up yields here at the short end, they're going to really put a floor on where the 10-year note can go. So we don't expect to see a big rally from here. Indeed, we think we're kind of in a range and yields may go up, giving us a better entry opportunity in the first part of next year, but unmitigatedly bullish for 2023.
Jim, final word here.
Yeah, I agree with a lot of what Rob said, that you're going to see probably a parallel shift in the yield curve. If the Fed's going to keep raising rates, a quick statistic for you, the 2-year note yield has always peaked above the terminal rate. If the terminal rate's going to 5 to 5 1/4, then the 2-year note will probably peak above 5 1/4, and parallel shifting, that means it's going to drag the 10-year higher. I agree with Rob, the yield curve is probably not going to get much more inverted than it is now. Most of the yield curve flattening to inversion is behind us. Its steepening might be a way off, but I don't think you're going to see much more flattening, so everything kind of shifts higher with the Fed.
Jim, can I just pick up on one point? Are you saying that 480 earlier this year was the high and the Fed won't get there? Or are you saying the Fed's going further and the 2-year wasn't the high?
No, I think the Fed's going to 5 to 5 1/4 in the terminal rate, and the 2-year note will have to go to at least 5 1/4 because it always peaks above the terminal rate.
Jim Bianco of Bianco Research is going to stick with us alongside Rob Waldner. Right now, equities are lower by a little more than 1% on the S&P 500. Coming up, the Fed speak returns.
My colleagues expect the Fed funds rate to get to, say, 5 to 5.5% next year. I think that gets us into that hopefully sufficiently restrictive stance of policy.
That conversation up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
colleagues expect the Fed funds rate to get to, say, 5 to 5.5% next year. I think that gets us into that hopefully sufficiently restrictive stance of policy that will bring inflation back to 2%. So I am getting increasingly confident that we're getting closer to that point, but obviously we have to watch the data. The inflation and other data have surprised us, and we need to be on the lookout for that, but I do feel we're getting to a better place.
Markets and you at home getting a fresh dose of Fed speak with San Francisco Fed President Mary Daly and Cleveland Fed President Loretta Mester all on deck later today. Mike McKee catching up with President Mester a little bit later this afternoon. Mike McKee, your highlight from this morning and looking ahead, what do you want to push just a little bit firmer this afternoon?
I think we got to push on the fact that Wall Street and the Fed are at loggerheads over where the economy and inflation is going. I mean, what Wall Street wants to know is why was the inflation forecast for the end of 2023 raised, and why is the growth forecast lowered to near recession? Is this all about trying to tighten financial conditions? And also whether or not the ECB and Bank of England hikes affect the U.S. I just threw that last one in there, John, for you. Because when you look at it, the Fed has now raised its forecast for where core inflation is going to be, the PCE measure, at the end of the year, at the end of 2023, and it has dropped its growth forecast. Well, the markets have gone the other direction. Here's what has to happen. Our Matt Bosler crunched some numbers and basically found out that the PCE core index would have to rise 0.7%, which would be the largest rise since 1974 in the month of December, to get us to a 4.8% PCE core rate for 2022. And Jay Powell said our jumping off point is going to be the fact that we had a higher rate at the end of 2022, and that's why we're higher in 2023. Could that happen? Well, you can't say it won't happen. Is it likely? Not really. So we still have a lot of questions about what the Fed is doing and why.
That's the conversation we're going to have, Mike. Can we squeeze it in? France or Argentina? I mean, that's what we're watching, right?
That's
over
why
the
everybody's.
weekend.
I mean, everybody's leaving the office today, and that's what they're going to be talking about, not the Fed. But they'll be back to it on Monday.
I'm sure. Mike McKee, thank you, Mike. As always, do not miss the conversation. Mike McKee sitting down with Cleveland Fed President Loretta Mester, Bloomberg TV, 3:30 Eastern Time. Back with us for a final word, Rob Walner, Jim Bianco. Jim, can we start there? Mike's talking about it. This tension between what the market's looking for, rate cuts, and what the Fed is looking for next year, anything but.
Yeah, in fact, the divergence between the market and the Fed is one of the largest we've ever seen. You know, the market's got the terminal rate peaking under 5% and rate cuts starting in the second half of the year. The Fed's got it peaking above 5 and holding there all year. So next year, 23, is going to be a year where somebody's got to give. Does the Fed give to the market, or does the market have to give to the Fed? 2022, it's always the market, always talking about pause, pivot, step downs. Most of the time the market was wrong, and they had to come to the Fed. If they have to come to the Fed again in 23 by readjusting their sights higher on interest rates and the terminal rate, and when the Fed's going to start to finally cut, then we could be in for some rough sledding, because I think a lot of the market is hoping that we're going to see some kind of a pivot in 2023, and the Fed is not projecting that right now.
Hey, Jim, your best guess then. You look at that spread right now, it's the market coming up to the Fed and not the Fed coming down to the market?
Yeah, I think so. I think that the market's going to have to realize that the funds rate they think is going to be around under 4.5 by the end of the year. It's probably going to be closer to 5 by the time we get to 1 year from today.
Rob, what about you?
I think the Fed is going to have to come to the market, especially the second half of next year. I mean, if we run several quarters of below trend growth and break evens, continue to come down here, and so the Fed, the Fed, I think, will be in a position where they're looking at inflation really coming towards their target, growth very, very weak. The pressure on them will all be about supporting growth. The inflation, panic will be over. And I think they'll probably be cutting by the second half of next year. So they'll have to come to the market.
So it's interesting you two both disagree on this, but agree on buying bonds. Jim, can you help me work that out?
Well, a lot of that has to do with what Rob said, is that you've got a yield now. So when you started the year and rates went up, you were getting no yield. You were just getting loss from the price. But right now, with the yield, that is a big cushion for bonds. And so while the first half of the year you could see yields go, or prices go down and yields go higher, you're getting paid to own them now, something we haven't seen in quite a long time.
Final question, indulge me, even if you don't care. Pick one, France or Argentina. Rob Waldner.
France.
Jim.
Oh, the ghost of Saudi Arabia. I'm going to go with France, too.
There we go. Jim Bianco, Rob Waldner, to the both of you. Fantastic as always. Appreciate it, gents, this morning and for the whole of this year. I really do. Thank you. Equity futures right now down a little more than 1 full percentage point on the S&P. Coming up the morning calls and later, weaker consumer confidence painting a gloomy picture potentially for 2023. That's the view of Julie Beale, of Kane Anderson Rudnick. Julie joins us around the opening bell. The opening bell, 7 minutes away.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
About 4 minutes away. Equities down across the board here. Negative 1 percentage point on the S&P, and the Nasdaq down about 0.7%. That's the price action. Here are your morning calls. First up, JP Morgan upgrading Meta to overweight 150 price target, citing increased cost discipline and a favorable revenue outlook. That stock is up 1.6%. Goldman resuming its coverage of Delta with a buy rating, $40 price target, highlighting continued growth of revenue streams. That stock's unchanged in early trading. And finally, Piper Sandler raising its price target for Adobe to $380, saying strong earnings provide a measured optimism entering 2023. We're up there by 4.8%. Coming up, Americans spending less heading into the holiday shopping season. Julie Beale of Kane Anderson Rudnick expecting the weakness to cascade through the economy next year. Julie's coming up next. Your opening bound just around the corner. Futures lower by 1.2%.
from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
This is a simple case of where did the money go?
And the technology.
If people wish to invest in it, they must be prepared to lose their money.
I am still very positive on real utility into this space.
Bloomberg Crypto, Tuesdays.
Down on the week, down on the session, heading towards a weekly loss on the S&P, the Nasdaq as well. Right now, going into the opening bell, equity futures are lower by 0.9% on the S&P. On the Nasdaq 100, we're down by about 1/3%. The Russell, the small cap, softer as well by about 1 full percentage point. The opening bell in New York rings, switch at the board and get to the bond market. We look like this. Just in the last 10 minutes or so, yield starting to pick up a little bit more. Up 9 basis points now, 353.70, in and around the highs of the session. Given what's happening in Europe, coming along for the ride. Big moves over in Europe. Euro dollar just about holding on 106.23. We're negative just 0.05% on euro dollar. Crude down by more than 3%, $73 and about 66 cents. In the equity market, about 20 minutes into the session, we open up lower by 0.6% on the S&P. On the Nasdaq, we're down by around about 1/3%. The number one stock to watch at the open is Goldman. The company reportedly preparing to cut as many as 4,000 jobs. The stock is down by 1.5%. Joining us now is Bloomberg's Sri Natarajan. Sri, what is going on with this one? Because earlier this week, I thought it had one less zero on the job cuts coming up.
What you had earlier this week, John, was plans in the consumer banking division that they're already set in motion and plan to eliminate jobs there. What we're talking about now is a more firm-wide push where managers have been asked to find places where they can identify cost savings across the firm. And that is what gets you to this much bigger number of potentially Goldman Sachs cutting 4,000 jobs, or roughly 8% of its workforce, because you have a situation where the firm is not meeting its profitability target. Through the first 9 months of the year, it is lower than the revised higher target that it set earlier this year. It's even lower than its previous targets. And knowing that there is an uncertain economic environment ahead, knowing that they've already seen a slide in deal making and asset prices this year, and compounded by the mistakes they made in their consumer banking foray, Goldman is searching for costs to save. And unfortunately, that could result in a number of job cuts.
Sri, Lisa earlier this morning said there's nothing normal about anything these days. And I agree with her, and I think a lot of people do. But Sri, can you try and help me understand what is the normal, the typical amount of people that would get laid off at a firm like this one on an annual basis?
So that's the dynamic that we have to appreciate a little bit here. Unfortunately, Wall Street has this habit of what it calls an annual exercise, which weeds out underperformers. That could be as many as 5%, but over the past several years, it has come in much lower than that. And especially in the years after the pandemic, it has been a non-existent process. Goldman itself re-upped that process a few months back when it went with cuts, which were much lower than what they might have typically done. But just in the remaining few months, they've really clearly understood that that's not enough. They have to go deeper. And now the plans that they're mulling, the plans that they're weighing, is much higher than what you would see as the annual performance cut. So this is not what you would call your routine cuts.
Sri, you've touched on this morning and through your reporting over the last several months. Can you just compare and contrast Goldman with the rest of the street right now? Sri, are you expecting the same thing to take place at a Morgan Stanley, at another big investment bank on the street?
John, without a doubt, every bank out there is looking at cost. That is the big item on every CEO's mind. However, what we've seen from Goldman, or what we're hearing from Goldman, and the mood music out of that firm over the last several weeks, has been a lot more cautious than anything else we've heard at a Morgan Stanley or Bank of America or JP Morgan. Yes, they're all facing challenges. Yes, they're all talking about costs. And yes, you will see job cuts there. But none of the plans that have been outlined so far seem to be as severe or as steep as what Goldman Sachs is planning. And part of that is tied to the fact that there are some unique challenges Goldman's facing, right? Even in a deal-making slide, even when asset management prices have slid, and even in an uncertain trading environment, Goldman knows that it's best to back in a lot of those places, especially when it comes to investment banking. Pretty good when it comes to trading. But it also had this little experiment into consumer banking that was not its forte, did not do well. It has already laid out plans to unwind that expansion. And couple that with all the technology spend, the integration costs that you've seen at the firm, you're left with a situation that is a little more distinct and separate from all their competitors.
Interesting. Sri, tremendous reporting. Brilliant. As always, buddy, thank you. Goldman down by 1.28%. You can see it across the board this morning. The whole sector struggling. Morgan Stanley, much more so, in fact, compared to some others. Starbucks this morning, down about 1.5%. Another stock to watch. The labour market pain echoing throughout corporate America. Starbucks facing a walkout of more than 1,000 employees, baristas across the country, starting a 3-day strike amid souring contract talks. One union employee saying, quote, "We just want to show Starbucks that we're going to continue escalating until they respect our right to organise and actually come to the table to bargain in good faith." Kelly Lyons has more. Hey, Kelly.
Hey, John. Well, this would be the biggest multi-day work stoppage ever for Starbucks Workers United, which, of course, is the union in question. It's 50 different store locations across the country that will be striking for 3 days, and then another 50 who aren't doing that full period will be striking for 1 or 2 days to support this effort. It really underscores the rising tensions between Starbucks and its unionized employees. Organizers say the strike is because the company is not bargaining fairly on the things that they are pushing for, which includes better pay and protections against benefit cuts. And this campaign really began a year ago when Starbucks Workers United won its first election at a location in Buffalo, New York. And even those workers still do not have a union contract. And when I say 1,000 employees involved, we also have to put this in context because that isn't a small number, but it also has to compare to the 402,000 employees that Starbucks has. That makes them the 8th largest employer in the S&P 500. But when it comes to how much money Starbucks makes per worker, it's actually the 7th lowest, only around $80,000 in the last fiscal year. So that really highlights why this is a company that may be ultra sensitive to employee costs. It could help explain the difficulty coming to an agreement here with the union. And there is a question, John, as we discuss job cuts elsewhere, how much bargaining power labor ultimately has in this environment.
Totally, and how much that's shifting over the last couple of months. Katie, thank you. As always, Kelly Lyons there. We're trying to work out where we are going into year end. Never mind trying to work out what the rest of 23 looks like. The next 2 weeks is hard enough. This from Morgan Stanley's Ellen Zentner. Well, last year customers rushed to buy gifts. Consumers rushed to buy those gifts early due to low inventories. This year, 70% of consumers are waiting for discounts before starting their holiday shopping. As such, holiday spending will likely be softer this November, December, with more shopping backloaded. Julie Beard, Kane Anderson Rudnick, expecting consumer confidence to weaken into the new year. And Julie joins us right now. Julie, great to have you with us. Thanks for being with us. We've talked about this through much of this year, just the path, the trajectory this consumer's on. Julie, can you share with us your latest read on things?
Yeah, I think that point is quite accurate. Consumers have been holding back, waiting to do their spending because they know there are better discounts. They've all heard about inventory, excess bloated inventory, and they're seeing it in the stores. You're seeing much more desperation in the tone of your kind of daily email to remind you that Christmas is around the corner. I think that consumers are well aware of the fact that inflation is hitting their pocketbook, and they're more hesitant to spend in the same way they did last year. They don't have the same level of savings they did last year, starting to have a little bit more credit card debt. And I think, Jamie Dimon's comments that we're going to spend down this savings excess that we have through the middle of next year, to me, that rings true.
The struggle people have, Judy, as you know, they're trying to figure out still if it's a change in the mix or a change in the level. Because when you hear from companies like Delta earlier this week, who are basically saying profits up going into year end, profits up next year, and you hear that from the other airlines too, it's a bit of a struggle for some people to work out which one it is. Is it a level that's coming down or just a change in the mix? Julie, which one is it for you?
I think it's probably a change in the mix. I think part of what the Fed is paying attention to is what parts of the economy are really the strongest and seeing the most amount of price increases. And that is in trying to ascertain if price increases are starting to become entrenched. And if they become entrenched, that changes consumer behavior. What I think is tricky about something like looking at an airline is the sensitivity that business has to business spend. And if you see a market softness in the economy, I'm not going to be traveling nearly as much. So I think it's hard to use that.
So Julie, just more broadly for the equity market, as you look at corporate America to gauge what's happening with this economy, where would you expect the weakness to show up first? And is it a case of first in, first out in an equity market downturn?
I think you're going to see it the most in consumer discretionary. I think we're going to continue to hear retailers saying that it's not as strong. I think we'll see it starting to happen too in restaurants and in the services, which had been booming once we started to reopen again. Those are the two places that I would pay the most attention to. But I also think it's going to start to occur in places like software, where you've typically seen a lot of resilience, where businesses are really going to look carefully at all of their spend and say, where can we trim where it's not going to have a major impact? And I think software could be one of those places.
How does that shape where you want to be then in the equity market into 23 then, Julie?
Throughout all of this, even with this much volatility, we haven't changed very much where we're positioning. We're still looking at businesses that we think have durable competitive protection. So, the quality is still important. I'm not, a hater of software writ large. I like a business like Tyler Technologies that serves the government sector, because I think they're going to be less cyclically sensitive in a downturn. So I think you have to take it on a case-by-case basis.
What about the financials? And I bring up the banks because Mike Mayo of Wells Fargo made a bit of a headline in the last 24 hours. He said banks could climb 50%. This was the quote, Julie. I'll share it with you. Banks should perform better in an upcoming recession than for any other in modern history. Banks have prepared for this moment for over a decade. Now, Julie, you could make the argument that, relatively speaking, because of that, you could get some outperformance relative to other particular parts of the market that might suffer because of recession. But to make the argument that we'll get an absolute return of 50% is a pretty big one, Judy. What's your thoughts on that, on these financials?
Yeah, I thought that was a pretty bold statement, but I think what he's saying makes quite a bit of sense in terms of the structure a lot of these banks have set themselves up. And in Shree's reporting, one thing that's important to think about with Goldman Sachs is they don't have the same exposure to benefiting from a rising rate environment. They don't have this backstop of credit and being able to benefit from higher net interest margins, right? They're investment bankers primarily. So I think you could see some opportunity for the financials to outperform those that are going to benefit most from a rising rate environment. The question is how are they going to differentiate themselves? And I think that's where we at Kane have really struggled to invest in some of these financials.
Judy, are you encouraged by the cost discipline that seems to be returning to tech, to Wall Street?
Yes, I am thrilled to see it. I think, the way that what was happening in tech was just spending hand over fist with no regard at all towards profitability. It makes it very hard if you're a long-term investor to say, I think the underlying earnings power of this business is X, Y, Z. You can't tell because they're just spending so much money on, I'm not really sure what, but I'm sure it's a good idea.
The greatest test of this, I think, Julie, is Facebook. Meta is up 4% in early trading. You heard the call from JP Morgan upgrading Meta to overweight, 150 price target, citing increased cost discipline. Julie, does it encourage you to the extent that you would look at a stock like that?
I think that the struggle that I have with Meta is obviously the structure of the governance makes it that, if Mark Zuckerberg continues to want to be an aggressive pursuer of the metaverse, he can do that. There's nothing that really stops him. And so for us, the governance issue is a real challenge. The underlying business of Facebook and Instagram are still pretty positive. It's still going to be okay relative to other social media platforms, say like, Twitter. But I still think on a governance issue, the cost discipline is great, but until they make more clarity around what the economics of the metaverse are, a no for me.
That stock's had a tough year. It's having a better morning, that's for sure. It's up by almost 5%. Julie, love this. Thank you. And thank you for everything this year as well. Been brilliant to catch up with you through 2022. Looking forward to doing the same through 23. Coming up, EU leaders looking for a gas price cap deal.
Just look at how much of the surplus in gas was eaten through with the cold we've hit. You can see the impact it's having on the gas inventory surplus. It's just making it go away very quickly.
That conversation up next.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Just look at how much of the surplus in gas was eaten through with the cold we've hit. You can see the impact it's having on the gas inventory surplus. It's just making it go away very quickly. So if this weather pattern continues, by January, you start to have a pretty significant problem. This market is still on a knife edge equilibrium, and what you're potentially creating here is potential for a pretty significant upside price spike.
Jeff Curry over at Goldman seeing commodities soaring in 2023 amid Europe's energy crisis. EU leaders pushing for a gas price cap deal with ministers when they meet on Monday. This is Western natural gas inventories in the US plunged to their lowest level in more than a decade. Team coverage starts right now with Bloomberg's Maria Tadeo in Brussels, AMH down in DC. I want to start with the situation on the ground, AMH, and I want to talk about what's happening in Ukraine. Kremlin forces reportedly launching over 60 missiles at Ukraine in the last 24 hours. 40 of them launched towards the capital of Ukraine. And as you've just seen, and I've just seen, John Kirby of the National Security Council saying he sees indication that Russia is planning an imminent move on Kyiv. AMH, what are they seeing?
Yeah, that's what Admiral Kirby from the National Security Council is briefing reporters this morning about this imminent move they are potentially seeing from Russia to make on Kyiv. And this is something that they said they are going to be watching closely and coordinating with their partners in Ukraine. Jonathan, this is on the heels, though, of yesterday, a top Ukrainian commander saying that there was no doubt Russia was going to make a move on Kyiv in January, and this commander said potentially that was going to come from Belarus. We do know that Russia has moved thousands of troops into Belarus, and not so coincidentally, Putin will be in Minsk on Monday meeting Lukashenko.
Maria, we were talking about the Patriot missile defense system a little bit earlier this week. Anne-Marie and I talked about it earlier this morning. Still, no decision that's been made on that. Are they crying out for that defense system right now? And are those cries getting louder?
Well, Jonathan, that was exactly what President Zelensky said yesterday when he spoke to European leaders at a meeting. Of course, all of this happens behind closed doors, but I know from very good sources that this really matches what U.S. intelligence is seeing, and everything that Anne-Marie pointed to. This was something that President Zelensky himself stressed yesterday to European leaders, that the war is in a very active phase, and if you think this is going to end anytime soon, you're wrong. They also do not believe that Russia, for the time being, wants a diplomatic solution. So basically, you're looking at a battlefield, at a drone war. Now, he did ask for the air defense systems. He also asked for tanks. But when it comes to the air defense, that is more doable. When it comes to tanks, that is a question that still splits European officials and European diplomats, because, again, there is always this concern. At one point, do you become belligerent in a war where you say you want to help Ukraine but not be an active participant?
Anne-Marie, when do you expect a decision to be made on this?
I don't know yet, to be determined. I mean, the reporting is that it's all lined up and ready to go. It just needs the president's sign off. So I imagine somewhat soon, but we just don't know yet.
Maria, looking ahead to these talks on Monday, how does all of this shape those talks around what the Europeans can do around the energy story into next year?
Look, it's a reality check that the energy pressure is going to continue because the war is going to continue, and the pressure is on the energy for Europeans, but also for Ukrainians. We've also seen that Russia is ready to weaponize this at all times. Now, what I can tell you, Jonathan, is that yesterday European leaders met in Brussels, as I said, and behind the scenes, they now agree they want to see an intervention in natural gas prices. That is the TTF benchmark. They agree it no longer reflects the real energy mix of the European Union, which has drifted away from Russia, and they want to see a maximum price cap. That means transaction will be closed once you get past a limit. At the beginning, the idea pitch was 275 euros megawatt. They're now debating a range of 160 to 225 euros. We still don't know the final price point, but what we know is that there is a firm deadline, and European leaders want this thing done now, on Monday. They do not want this conversation to drag into 2023.
AMH, final word. This, of course, addresses price, doesn't address supply. What does the supply story look like right now, going into next year?
Well, I mean, we have to just look domestically what's going on in supply. And if you look out west, Jonathan, the inventories are at the lowest level for this time of year in more than a decade. And this is critically important to California, which in the past has had issues with their energy grid. And you've been talking about it the entire year. What will likely dictate this is the weather. So if it continues to be cold and people are in more need of heating demand, those inventories are going to come down. It's interesting, though, because at the same time, California obviously imports most of their natural gas, or all of it. The United States is also sending more than the president even promised to Ursula von der Leyen in March in Brussels when me and Maria were there, to Europe, because they really are in desperate need of that LNG.
I say this nearly every time the two of you come on together. Truly, two of the very best. Thanks for being with us, Maria and AMH, on the latest in Ukraine and the energy story for Europe and for the United States as well. Here's the latest data. Just a preliminary read for the month of December for the PMI in America. So the US manufacturing PMI comes in at 46.2, survey 47.8, previous 47.7, services 44.4, that is not pretty, survey 46.5, previous 46.2, that leaves the composite at 44.6. We were looking for 46.9, that's down from 46.4. Katie Lyons, they're not great numbers, are they?
They're not. And are we back to a bad news is bad news kind of scenario for this market if what the Fed expressed this week is that it is going to continue to tighten into softening economic data? That is what is weighing on risk sentiment again today. You do have the S&P lower by about 0.5%. What is leading that underperformance is energy, which you three were just discussing, as well as real estate. Both of those sectors off by more than 2%. Interesting to see the outperformance coming in the tech space. Tech is positive, and communication services up 0.7%. That has everything to do with Meta outperforming. It's up about 6% as you were running through with Julie earlier. On the week, though, communication services, one of the underperformers sector basis on the week, including consumer discretionary financials and materials as well, all down in the ballpark of 2 to 2.5% on a down week for equities, John.
Hey, Katie, thank you. Appreciate it. Coming up, your trading diary, live from New York. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
25 minutes into the session, down on the week, down over the last 3 days on the S&P. Trying to stage a recovery, though, over the last 5 minutes or so. We're down just 0.5% on the S&P. Just about positive on the NASDAQ by 0.2%. Meta making a move. We talked about that a little bit earlier. Let's talk about the bond market, 2s, 10s, and 30s. Just a bit of a lift through the yield curve. Just a bit of steepening coming back in. Up 6 on a 10-year to 3.51. That's the price action. Here's your trading diaries. Fed speak continues. San Francisco Fed President Mary Daly at noon Eastern. Mike McKee, Loretta Mester, 3:30 p.m. Don't miss that. The World Cup finals taking place on Sunday. Don't miss that. France versus Argentina. Looking ahead to next week. EU energy ministers meeting on Monday. Existing home sales in America and consumer confidence coming up on Wednesday as well. From New York, that does it for me. Enjoy your weekend. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people.